We welcome to our today topic related party transaction, its audit, disclosure and its compliance. I welcome you all and I heartily welcome our speaker CA Manish to occupy a dais. I request all to please rise for our mottos of
सुप्तेषु जागृति य एष सुप्तेषु जागृति कामं 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 कामुषो पुरुषो निर्विमानः तदेव शुक्रं ब्रह्मा तस्मिन् लोकः शिवः सर्वे तदुनात्यपि कश्चन एतद्वैता
Please be seated. UFO video will be played.
Arthashastram, Dharmashastram cha, meaning economic principles, Arth, and ethical considerations, Dharma, which are central to the work of accountants. The entire world is deliberating about the impact of climate change coupled with disruptions of artificial intelligence. India has given philosophy of Vasudhaiva Kutumbakam to the world and successfully hosted G20 summit on this theme and also launched Global Biofuels Alliance. The accounting profession also has an enormous responsibility to guide the world, where accountability meets innovation so that vision can be converted into solution. The Institute of Chartered Accountants of India, being the world's largest accounting body after the successful hosting of WCOA 2022 and GLOBAC, proudly presents before the World Forum of Accountants 2025. Where accountability meets innovation for a sustainable planet. The world's brightest minds will exchange insights, explore emerging trends, and unlock the possibilities for the profession, where foundation will be laid to shape the vision for the future of accounting profession. Hosted at Yashobhoomi, the largest convention and exhibition center in the heart of India's capital, New Delhi, inaugurated by the Honorable Prime Minister Sri Narendra Modi, is all set to host the congregation of accountants from around the world. And while you're here, experience the vibrant culture and heritage of New Delhi, a city where history meets modernity, offering unforgettable memories.
World Forum of Accountants, an experience of 3 days, insightful discussion, groundbreaking innovations and unparalleled networking opportunities.
With immense pride, we invite you to WOFA 2025, taking place, happening from January 31st to February 2nd, 2025 at the magnificent Yashobhoomi, New Delhi. Experience 3 days of insightful discussions, groundbreaking innovations, and unparalleled networking opportunities. World Forum of Accountants 2025 is where you need to be, where accountability meets innovation, AI for a sustainable planet. Join us at WOFA 2025 from January 31st to February 2nd, 2025 at Yashobhoomi, New Delhi. details, visit wofa.icai.org.
It's my pleasure to introduce Speaker CA Manish sir, who has an overall experience of 17 years in audit and assurance services, undertaking multi-folded assignment relating to tax, statutory audit, IFRS audit, assistance in IPO services, tax audit, Ind AS, IFRS transition, due diligence, GST or VAT audit, internal control over financial reporting, complex accounting assistance services, etc. He empaneled at the Independent Directors Bank constituted by NCA, attended the certificate course on business report responsibility and sustainable reporting conducted by ICI, proactively provided various suggestions, comment on technical and administrative issues to various committee of ICI as well as various ministries formally as well as through social media. Speaker at Study Circle of CA Association and at the Controller and Auditor General of India, contributed by way of articles to ICI journals and other professional journals, contributed to and co-authored several articles focusing on current trend and development in the accounting and auditing domain. Thank you, sir, once again. I request CA Girish sir to present the memento to the speaker. Hand over to the speaker.
Good morning, friends. The topic is SA 550, Standards on Auditing 550, which is with respect to audit of related party transactions. And the standard as such provides a lot of principles. May look at times when you read the standard as such, looks like some of them are jargons. But a lot of the principles are real practical, and if you start correlating it with some real-time examples, you will find them a lot more practical and value-added insights. With respect to that, I'll probably start off with one example. The standard says, related party transactions outside the significant or the normal course of business, or lacking a business rationale or with unusual terms. Please verify those and get into the business rationale of those. Probably we'll have to go to the biggest corporate fraud in India's history, which was Satyam in 2009. And if one reads, I was of course part of the Satyam audit for 10 months. When I was doing my stint in Deloitte, but of course this is something which is there in the public forum. And this was part of the confession by the erstwhile chairman, Mr. Ramlinga Raju, wherein the particular transaction which caught the media's attention, the investors' attention, was in December 2008. Satyam went ahead and acquired, proposed to the board to acquire Mehta's. Mehta's was the promoter-owned entities. It was owned by the sons of the promoter, which is Mr. Ramlinga Raju. Mr. Teja Raju and his thing owned those entities. And the proposal was, Satyam was an IT company, Mehta's was a real estate company into large infrastructure projects as well as residential and commercial projects. To that extent, the proposal was to acquire. And a lot of deliberations happened at the independent directors meeting, which is well documented in media, and also because post when the fraud investigation happened, all of those came to media. There was a lot of deliberations, and when finally some independent directors abstained from voting, some independent directors voted against that, but finally the proposal went through, and there was immediate reaction from the market. and the investor said that, you know, corporate governance has been is a sham in this company. How can a board of an IT company, which is the third largest company, how can it approve a large transaction, such a big related party transaction which does not have any business rationale? How is a real estate company and a software company integrated? This, that, and the US markets, the share prices in the US market stumbled. It was listed in US. It was listed in India. The share prices in the India market stumbled, and then the transaction had to be put on hold. Subsequently, the confession letter told that the reality was, through this related party transaction, the assets of Mehta's, which were real in nature, were supposed to be brought inside Satyam's balance sheet, and the payout was supposed to be made through the fictitious cash balance. So I had a fictitious cash balance of almost 6,700 crores sitting in the balance sheet, and that was supposed to be given to the related parties. It would have actually not gone out. So while this was perceived as a wrong transaction, but the way it was actually was, it was supposed, the related party transaction was supposed to save the company, which of course, when the hue and cry happened, no one realized the veracity of the situation until the confession actually came. And a simple journal entry would have been, the assets of Mehta's would have come in. So all my assets debit, and the fictitious cash balance to cash gone out. So all the fictitious cash balance eroded from the balance sheet. Unfortunately, that did not happen, and we saw what followed thereafter. So a typical related party transaction, you know, which sorts of, you know, an unusual transaction, unusual terms, and something where you can sort of hide things through related party, and that's why the entire focus, you know, we see all regulators and everyone sort of focusing across. In India, we have such a complex gamut of related party transactions and disclosures. Your Companies Act has a separate set of requirements in terms of the board approvals, the shareholders approval, the audit committee approvals, etc. The SEBI LODR goes a step further, where they say that even the material subsidiaries have to get the audit committee approvals, etc. Income Tax Act has its own set of provisions. It has 48 to be related disclosures, as well as an assessing officer can challenge. You have international transfer pricing, where the transfer pricing officers could challenge your transactions with international, so that are you suppressing the profits in India, which is supposedly a relatively higher tax jurisdiction across the world, and are you moving profits to another country where, you know, where the tax rates are less? So that's, you have that. Under the GST laws, you have a complex set of valuations and assessments. Under the customs laws, you have something called a special valuation bench, which deals with related party transactions and assessment, whether you imported it, are you paying the right duty for that? So a whole set of laws, and then, you know, of course, your financial statements has the relevant set of disclosures. One needs to remember that while in an audit, the principle, when we consider from a financial reporting perspective, we are not supposed to, as such, directly confirm the arm's length nature of the transaction. So the financial statements never confirms that the transaction are at arm's length. What's an arm's length? It's simple. Two unrelated parties, at what price they would have transacted for that particular transaction, whether the same is being done by the related parties as well. So, of course, there are a lot of principles and methods to arrive at arm's length and these, but the overall principle is whether, in the financial statements, whether in AS, Accounting Standard 18 or in AS 24, you don't look at whether the transaction are at arm's length. So, the arm's length principle majorly covers under under the Income Tax Act and the GST laws and the customs laws. But where it could impact from an audit of financial statements perspective, the audit could be impacted when, because of our CARO reporting, where you are supposed to comment on the compliance with section 188. Now, what does 188 state? 188 states that the auditor is just supposed to confirm the compliance with section 188. That's it. That's the only one-liner statement it is given. But 188, if you go and read, it has a whole set of this thing, that transactions which are a bunch of transactions which require board's approval, and if it goes beyond a numerical threshold, shareholders' approval. But there is a proviso in that section that it says that neither board approval nor shareholders' approval is required if two conditions are satisfied: ordinary course of business and if it is at arm's length. So, companies who do not go for the board approval, effectively for getting the board approval or the shareholders' approval in case it exceeds the threshold, are effectively indirectly telling that it's at arm's length, and therefore I am not going to the board and the shareholders. And therefore, the audit, so that's the proviso which says that it has to be at arm's length, and therefore the auditor, because of the 188 reporting obligations, is supposed to confirm. Many times we have a practical scenario where the auditor actually says to the company, I am not in a position to confirm arm's length, you better go and take the board's approval and the shareholders' approval. So, because we don't know whether it's at arm's length, so if a board approval is there, I will anyway say that 188 board's approval has been taken. So, I don't then have to get into whether it's at arm's length. But practically, if one had to assess, then either the auditor has to independently perform his procedures, see to it, you'll apply the methods. It could be a comparable uncontrolled price method, wherein what is the price at which you are selling to another party, etc. Or if you are not doing that, then you could probably do another method. You could do something like a retail sale price method fix. These are methods which are prescribed in Income Tax Act. Companies Act does not provide any method to confirm the arm's length. It just says at arm's length. So one will go to the analogy of Income Tax Act to see what methods can be applied. And then one will apply those methods and see that it's at arm's length. So either the auditor himself performs it, or he insists on the management, boss, you go to an independent person, get it confirmed, give me the report. And trust me, from an audit perspective, you get the report and put it in your files, that's not sufficient. The regulator does not agree to that anymore. Go and read the regulator orders, you will find that he will say whether the auditor, as an auditor, have you confirmed the completeness of the data which has been provided to the expert. So it's a management expert, your SA 610 procedures will apply. Whether the management's competency, integrity and independence have you confirmed. Whether the output is commensurate with the input. So you have to perform all those procedures inevitably. That's something similar to what you do in the context of data provided to actuary for your gratuity valuations. You have to confirm the completeness of the data. The actuary will clearly put in his actuary report, I have not confirmed the completeness of the data provided by the company. So it's the auditor who has to confirm the inputs. So this same analogy will apply for a related party transaction also. If you are confirming, if an independent expert is confirming, you have to perform your relevant procedures from a skepticism perspective and go about it. So, broadly, I mean, we'll go through the specifics of the standard or something, but I just thought I'll, start off with an example of the Satyam Mehtas, and then as we go forward, we'll also have some more examples to see how the principles can really be applied. But as I told as a precursor, from a financial reporting perspective and an audit perspective, you are not directly in India required to comment. Even in section 48(2)(b) tax audit, what you are required to give is only the disclosures of the transactions which are covered under 48(2)(b). It is an information to the department for the assessing officer that when he does the assessment, he can see the arm's length nature and do the disallowance if he believes that it's not at arm's length. So 48(2)(a) will provide that powers that for transactions covered under 48(2)(b) of the Income Tax Act. Whether this thing. So as a tax auditor, you are not confirming this thing. Unlike 3CEB, where you are confirming the method and the arm's length under the transfer pricing regulations. But here, for a tax audit perspective, you are not commenting on the arm's length nature. You are only giving the disclosure of the related party transactions. It is left to the assessing officer to determine whether it is excessive or unreasonable and to make the allowance or disallowance accordingly. So a quick recap, because a lot of these things when we discuss about related parties, it will revolve around have you assessed the significant risk, have you assessed the fraud risk and things like those. So quick recap, audit risk-based approach to audit. You are supposed to get to the engagement risk factors which are normal, greater than normal. They say the standards provide that significant or unusual related party transactions might result in the engagement risk at an overall level being classified as greater than normal. So you have your normal risk, greater than normal, and much greater than normal. These are the three classifications from an audit perspective at the engagement risk stage which you need to assign. Lot of related party transactions could typically result in that being classified as a greater than normal. So once the engagement risk is classified and this thing, of course your engagement acceptance, also at many points of time you are supposed to do your engagement risk assessment procedures when you are accepting an engagement. And those procedures which you perform, one of the key factors which has been listed is see the group structure, see if there are a lot of related party transactions, see the previous financial statements. That would be one critical factor for you to, whether you are ready for the risk appetite. So if as an auditor, if you are not ready for the risk appetite of, very significant unusual related party transactions, then don't accept that engagement. So an engagement acceptance procedures, engagement risk assigning procedures, everywhere one of the factors you would find that related party would be one of the factors for all these assessments. Then you have your controls and risk assessment at a process level, your substantive audit procedures, then your final reporting, which is your normal audit report, true and fair view, and then followed with CARO, ICFR, etc., which are your annexures to the audit report. So you have a complete risk-based audit approach which is provided under the standards on audit. We know if areas where we believe that the risk is high, the controls are low, then we have to do a higher level of substantive testing. If the risk is less, the controls are better, then we perform a lower level of testing. As far as related parties are concerned, the general guidance provided is, while you can rely on controls, it is also better that if the controls are reliable in terms of identifying and summarizing, you still perform a focused level of substantive testing, so that it's this thing from a risk perspective, the risk is mitigated. Because the related, we all know that there are two presumed fraud risk factors. One is SA Standards on Auditing 240 provides for two presumed fraud risk factors. One is revenue recognition, the other is management override of controls. Both of this, more often than not, you will generally find that the party through whom this is perpetrated is generally a related party. So both revenue recognition or this thing, you will generally end up doing a fictitious sales, to boost up your revenues or the numbers. If there are fictitious sales, it will be to a related party who will actually confirm to you that yes, even if the auditor sends a confirmation, he will confirm back to you that the sale has happened and it's a receivable. So, management override of controls is another place where a lot of controls are actually overridden through related parties only. So again, the two presumed fraud risk, there will be this wall of related parties which will actually drive these presumed fraud risk factors also. So at each and every place, transaction level or at a entity level fraud risk factors, related party transactions are required to be factored in at my audit planning stage, subsequently at the controls assessment stage, and then subsequently at the substantive audit procedures, and then you are finally the reporting stage. The reporting, of course, will depend on the applicable financial reporting framework. Could be AS 18, could be Ind AS 24. I am not touching upon, the definition of related parties is across different statutes. Companies Act there are overlapping. Subsidiaries always a related party across any statute. But director interested entities and all this, the definitions are little different in each of this. Companies Act has a different definition, Ind AS has a different definition. So when you go for section 188 approval purposes, you have to look at the Companies Act provisions. If you are going to, for the financial statements, disclosure, completeness, etc., you have to go to the Ind AS definition. Because for financial statements, the definitions in Ind AS will override the definitions in Companies Act. So to that extent, these factors, and SEBI again has combined, the LODR has combined definition telling all related parties, whether under Companies Act or under Ind AS, both of them are related parties for my purpose. So they have told that my gamut is a bigger gamut, I will include both of them. So each definition is different. Please keep in mind, this thing. And an identification of related parties and assessment and this thing could be a separate case study session by itself. That's not part of my session, but I just wanted to give this this thing that under which framework are you reporting and how has to be kept in mind as part of the audit. So, the standard says that the auditing standard, your AS 18 and Ind AS 24 will cover, the disclosures part, who has to be identified and, what transactions have to be disclosed. But the audit standard provides what audit procedures you have to perform. How do you assess a risk? What audit procedures can you perform to identify the completeness of the transaction and so on. So, the standard says that if there is an applicable financial reporting framework, which could be in India scenario it is AS 18 and Ind AS, they have not specified those because the SAs are aligned majorly to the international standards on auditing. So the ISA is obviously framed for the global countries. In some countries you may not have a financial reporting framework at all. In some countries you may have, but the definition of related parties might not have been specified. So to that extent, they have just generally given if there is an applicable financial reporting framework, then you apply the audit procedures. If not, they have given a very simple definition. Wherever there is control or significant influence, those parties will be considered as related parties for the purpose of this auditing standard. But if the financial reporting framework prescribes, then you don't go to the definition which is provided under the auditing standard. You will apply only the procedures which are stated here. Now, if the applicable financial reporting framework does not provide a definition of related parties, does it mean that you don't have any risk in the audit? The answer is no. Of course, because of related party transactions, you will still have audit risks. So, what does, before we go to the specific, this thing as I told, across all standards you will find pervasive impact of related party transactions. SA 315 identifying risks of material misstatement. You will see that whether the risk involves significant transactions with related parties, whether the risk is outside the normal course of business or otherwise that appears to be normal, which is where I gave you a simple example of Satyam Mehta's, which was an outside the normal course of business and appears to be unusual in nature. SA 330 auditor's response to the assessed risk says that if you are sending like a confirmation and if a related party is confirming that, this evidence is lesser reliable than any other external confirmation. It does not stop you, but says that please be skeptical. A confirmation from a related party may not always be necessarily fully reliable as a confirmation from an external third party. SA 240, again they have given, which deals with auditor's responsibility in relation to misstatement for a fraud. There they have again given using one of the fraud risk factor could be using an entity's assets for personal use. For example, using the entity's assets as collateral for a personal loan or loan given to a related party. Now, as far as these are disclosed, approved, all that's fine. But if these are not disclosed and not approved, and then it could presumably be a fraud risk, which then again has to be evaluated also not just for your true and fair view purpose, but also for your section 143 subsection 12 central government reporting to the fraud purposes as well. SA 240 again, it states few more things, which is where I would maybe stop a little bit. The first one is related party transactions not in the ordinary course of business or audited, not audited or audited by another firm. So this is a risk which is stated as part of the standard itself. That in complex related party transactions or this thing where the management has a large group structure, generally it is one of the methods that they keep different auditors for different testing. That's the whole debate which is raging on currently with respect to SA 600 versus ISA 600. the regulator is fully onto it, and the complex structures as such are that different auditors are being appointed for different, so that no one has a complete picture of the entire transaction. No one auditor, and the holding company auditors would say money is given, it goes to an investment. I have seen only the investment part. The other subsidiary auditor says I have seen only this part, and the money keeps moving about the structure, and finally it's siphoned off to a promoter entity, and no one in the group actually becomes aware. Finally, somewhere some provision is created, and then it comes into the consolidated financial statements of the holding company. The holding company auditor says in the audit report, I have not audited this much of profits or losses, I have not audited this much of assets. This is what globally this practice, of course, we are all aware that globally this practice is not there. The holding company auditor is required to take the ownership of the entire group audit, even if he is not the auditor of this thing. So he is supposed to see the significant risk, and that's why listed companies audit SEBI has a separate circular under LODR regulations. The circular was precisely released only for the purpose that SEBI had an assessment that the current SA 600 was not commensurate to the group audits to meet the complexities of large group audits, and therefore it gave a whole list of procedures as part of the circular, which told that you have to send instructions to the component auditors, get their significant risk, get their key matters and assess that whether it is material at the group level, assess the competency, have discussions with them, and ask for their key accounting estimates. They just refrain from telling ask for all their work papers, except that everything else was stated in that circular. So ask for the audit summary memorandum, ask for the key matters to be communicated to those charged with governance at the group level. That means to the board of directors at the group level, what should flow from the subsidiary. So all of that was stated in the SEBI circular, but of course we have our arguments that circular is subordinate to the main regulation, this is prescribed under the act, that's a circular and all that. So probably the regulator felt nothing doing, let's align to this thing, and let's go back and see that the SA 240 already has this, audited by another firm, could expose the principal auditor or the main auditor to a significant unusual fraud risk. So this is, typically if one were to go back, if we would have tracked this thing, the Coffee Day order which was given by NFRA, which was also there in media, one of the significant points was the Coffee Day enterprises lent money to a maze of subsidiaries, lot of to money routing, and this thing, it was finally siphoned off to a promoter entity which never repaid back those monies, and then they were finally provided for. And these transactions went through a whole series. And very interestingly, the point which was put across was there was an audit committee approval for that transaction at the holding company level, which was a listed company, and this entity to which it was siphoned off was a promoter owned entity. So the monies went there, and the auditor was expected not just to see the approval, but it was told that why did you not challenge it? The professional skepticism that historically you purchased coffee beans in the range of 60 to 70 crores. Of course, I am not privy to the facts, what's there in the public, this is what is there in the public domain, the order is there. 70 crores is your annual purchase, and you have roughly given advances in the last 2 years. You purchased coffee beans from the related party in the range of 60 to 70 crores, but you have given an advance for the purchase of coffee beans to the extent of 350 crores per year in the last 2 years. Just because the audit committee has approved this, can you take the shelter of that? Are you not supposed to professionally challenge that skepticism? And that is, you will go and precisely see as one of the points which is there in SA 550, which says that the auditor is supposed to evaluate the control environment, that how much is the discussions around related party transaction at the senior management level and at the board level. If the discussions are not appropriate, and if the related party is expected to bulldoze the transaction through the board level, you know, get the approval without any major discussions, even if there are independent directors etc. on the board, then the standard provides that you are supposed to exercise your skepticism in seeing that whether the related party transactions are fraud. So let us take it that, you know, it is not the regulator who has just told that challenge the audit committee approval. The standards always told that. So I mean, the regulator is only emphasizing it more, that, you know, skepticism does not mean that just because your board has approved or your shareholders have approved etc. does it really mean, because as an auditor, while you might be reporting to the shareholders, but there are various other stakeholders which we start in our first chapter of auditing. Your regulator is one of the stakeholders, your employees are one of the stakeholders, your creditors are one of the stakeholders. So you are not just, your stakeholder as the auditor is not just the shareholders alone. So that's what precisely the regulator also told, that the audit committee might have approved or the board might have approved. It still didn't stop you from challenging that transaction and seeing through behind the walls that it was actually a money siphoning transaction. Year-end, significant year-end unusual transactions, reviewing the authorization and carrying value of loans to related parties etc. You know, and particularly loans which are colored as supplier advances. It's actually a method of funding the related party for carrying out his business and operations, but you give it the color of a supplier advance, and, you know, as if it's an advance in the normal course of business. Such transactions have to be viewed closely, provided in SA 240 and also repeated in SA 550. Indicators that the transactions may lack business rationale. Non-consolidated related parties. So if it gets consolidated, the investors are aware. But if there are any related parties which gets excluded from consolidation, particularly we know that, you know, this promoter-owned entities, where it's, if it's a group structure, the subsidiary or the associate gets consolidated. But if the promoter is there and if the promoter is there at the other place, that does not fall under your consolidation norms. So if there are non-consolidation related parties, particularly special purpose entities, if you have too many SPVs which you make and, you know, create structures around that, that could be one of the things where it's, and if it is not been properly reviewed or approved by the board of directors, where it's not challenged or something. The other thing which has also been told is, if the auditor identifies any related party transaction, a related party which has not been previously disclosed to him, that could typically be indicative of a fraud risk. Because if the management has a framework and if they have not identified it, and you through your audit procedures have identified those, then it could typically be indicative of a fraud risk. So those things have to be carefully assessed, and in that case it again goes back and also says that you will probably have to reassess the management representations, which will of course include the list of related parties which the management is giving to you, reassess the reliability of other representations also, reassess how much you can rely on the integrity of the management, because whatever said and done, an auditor has to rely on the management to trust the integrity of them. If you have enough confidence on their integrity, and this thing, it's one of the key audit procedures that you keep assessing the integrity of the management on a real-time basis. You might have been associated for them for many years, but you still keep assessing that on a real-time basis. So it says that if you start identifying related parties or transactions which have not been disclosed to you, please reassess your reliability on the integrity of the management as well. So, you know, the other standards, just generally what they have, you know, provided some indicators in terms of what specific procedures could be performed. As I was, telling you, for example, year-end transactions, particularly at the year-end, revenue recognition. I was part of a large audit where of a automobile company. It's a large automobile company whose C&F agent is a related party, and they have huge, they have obviously a portion of export sales, and to jack up that export sales, what they did was the goods had not either left out of factory, not even reached the port, or had just reached the port and the customs formalities were not yet over and it was not loaded on the carrier. We know that for FOB and CIF terms of sales, the revenue recognition is supposed to happen at the stage where the goods are handed over to the carrier or to the liner. So to evidence you have a bill of lading. Now this bill of lading, because it was a C&F agent who was related party, the bill of lading were exactly dated all either the 30th or the 31st of March. And all the bill of lading were this thing. As an auditor, as a past trend, we used to carry out procedures only where we will probably verify the invoice and the bill of lading. But seeing this unusual trend that suddenly the year-end sales have jacked up and you are having all the bill of lading the last 5-7 days, we asked for an extra document which was shipping bill. Probably until then we were not verifying the shipping bill, we were just seeing the commercial invoice. We told provide the shipping bill, and it typically appeared that all the shipping bills were dated in April, and your bill of lading can always be only after the shipping bill date. So you will have your invoice, then your shipping bill, then your bill of lading. So here it was a classic case that it was just a made bill of lading provided to ensure that the revenue recognition principle based on the bill of lading is satisfied. But the moment the shipping bill came into the picture, of course there was a lot of friction and pushback that you have never verified this in the past. Why are you asking this data now? What is the relevance? We are anyway giving you the bill of lading. That's the point of revenue recognition. Shipping bills is like an operational matter. It does not impact my finance, books of accounts, so on and so forth. But the moment this came in, it was a clear case. The entire sales had to be reversed. The impact, of course, the inventory came in, and the margin was obviously the impact on the profits. I mean, whatever was my gross profit margin. But to that extent, a classic case where a fraud, as I had also told, revenue recognition, the fraud perpetration through a related party. Presume fraud risk factor. See to it that the related party here was not the customer. The related party here was a C&F agent. So he was a related party, and of course this related party also, if you look at it in the India reporting framework, he does not actually fall into the related party. If you have to look at it at the global reporting framework, because it's an MNC, etc., it's a related party for the holding company. So the holding company has a subsidiary here, and the C&F agent also has a subsidiary here in India. So you have the global group situated somewhere outside, and you have the relevant subsidiaries operating in India. And it could be an associate structure or something, but the facts of the transaction were it did not fall into the definition of related parties in India, but it was actually in substance a related party. So that's where the standard says that don't get restricted to the definition, look beyond, look at the holding company structure, look at the holding company annual report, look at the minutes of the meeting, look at form MBP1, etc., which you receive from the directors. So it provides an indicative list. Obviously, it will not use the word MBP1 because, as I told, standards on auditing are aligned to the international standards. MBP1 is the declaration which the directors give under the Companies Act, and it just says read through the declarations received from the interested directors or the shareholders. That's the procedure. But obviously, in India's context, we have to interpret that as going through the form MBP1 and the disclosures, etc. So, key aspects of the standard. First, of course, identifying the risk of material misstatements associated with related party relationships and transactions. Consideration of laws and regulations which could impact related party transactions. I had given at my start of the session, you have Companies Act in India, section 188, 177, etc., on which we as auditors are also required to report upon in CARO. India is 24, of course AS 18 as well, Income Tax Act Section 40A2, you have Income Tax Act International Transactions Transfer Pricing Section 92A to 92F. Under GST law, you have related party transactions, valuation and time of supply rules, which are a little different. Special valuation bench rules for customs, and then SEBI LODR rules, which has again a whole set of transactions where, material related party transactions definition for Section 188 purposes, where you need to go to the shareholders for approval. Vis-a-vis material related party transactions definition in SEBI LODR for listed companies is different. It's not a clash, just that SEBI LODR provides some extra 5 items, and that also has to go in a listed company in addition to what goes under Companies Act. Typical, for example, you have this when the hue and cry arose around Maruti's royalty payments to Suzuki. At that point of time, then SEBI came with this inclusion that a material related party transactions includes royalty expenses paid to a related party which is more than 5% of your sales, is a material related party transaction which you have to go to the shareholders for approval. So it does not just end up with this thing. So that was an inclusion. You will not find this royalty expense inclusion separately in the Companies Act, and it will not provide this 5% of sales threshold, etc. Some sale of goods, services, etc. It provides 10% of the consolidated, 10% of the turnover. But here you have a lower limit, so obviously you have to comply with this as well. So you have a whole bunch of regulations which deals with related party transactions and disclosures and compliance related to that. Some, as I told, require arm's length, some require only a disclosure. Of course, I mean,
we have to mention whether it is complying Section 188. What about if for a company CARO is not applicable? Where do we have to disclose?
You are specifically not required to disclose this. So you don't have a disclosure requirement. But if it not at arm's length, then as an auditor, you have something to doubt at an overall true and fair view itself. So you have to look at it from an entity perspective on the true and fair view of the state of financials. So that's why you have all your fraud risk factors, significant risk that, irrespective of a specific reporting, please perform your procedures for the related parties.
Can we do it under emphasis of matters? Or?
If it is key, if you believe that it is key or this thing, then of course it will follow the judgment process. It also, you can put it, you will have to see whether it will be a qualification, whether it will be an emphasis of matter, or whether it will be an adverse opinion also. So it's not necessary that, just because only CARO is applicable or not, you will anyway have to evaluate, perform your audit procedures to see that, whether there are fraud risk factors, whether you need to consider them for a true and fair view state of the financial statements or not. So, understanding the entities, related party transactions and this thing, process and control of identification of related parties. Simple entities, not very complex, it may not be very difficult. The controls could obviously be manual, I might be maintaining in Excel or etc. But large group structures, I might have separate tools for reporting related party transactions, doing the knock-off, elimination for consolidation purposes, so on and so forth. So the process of identifying related parties, etc. has to be taken into account. That what is the timeliness and all that. Emphasis, of course, on professional skepticism, as I also told one example of Coffee Day where the regulator told, boss, why did you not challenge, coffee beans versus the advance paid, average annual purchase. Consider the risk of relationships where it's not disclosed, as I told again, whether it's a fraud risk. If the management has not disclosed you a particular related party and you have identified it through your audit procedures. Entities, what could be your sources of information? Entities, ownership and governance structure. In India, of course, one additional thing which would indicate the ultimate beneficiary or this thing is the SBO rules which we have in India, companies significant beneficial ownership rules. where if you have multiple layers of companies above you, who is the final ultimate individual owning 10% or more in your company, the company is required to do an assessment, reporting in form Ben 1, Ben 2, Ben 4, etc. A Companies Act compliance, which could serve as a good handy tool for you to identify the ownership and the governance structure. Inquiries with various stakeholders, you speak to the board of directors, the independent directors, internal auditors, the legal heads, external legal counsel, etc. to see what could be the thing. Your information maintained under various statutes could be your minutes, registers, register of directors, register of shareholders, the declarations which you receive from the directors, form MBP1, etc. Whatever, the annual reports which you are, the holding company's annual reports, or, other jurisdiction annual reports where in other countries if they are incorporated and there are annual reports which are available, publicly available, or available not publicly, but if you ask you can get it. The information which you maintain under the transfer pricing documentation, income tax rules, rule 10D, that could provide you a insight into the related party transactions. So information which is submitted, if there is a customs assessment, special valuation bench, etc. So those are things. In Income Tax Act, of course, we also have this provisions of this master file and country by country reporting for the larger groups which are more than 5,000 crores, etc. So in India, you are supposed to do the country by country reporting of how much profits. These are all part of the global OECD programs. So those could all typically indicate, information on the company or group's website. Just for this thing, I'll touch upon one example which, regulator, the SEBI has taken exception in two cases. One is there in the public domain and the other is not there for Vedanta Group, where they told that, the subsidiary and the holding company is into the same line of business, and the same line of business, the holding company is unlisted and the subsidiary is listed. But any expansion or acquisition which they do at the unlisted holding company level, if they open a new center or acquire a new mine or do whatever, is being displayed on the website. And this being displayed on the website and this being the official website being disclosed to the regulator and to the stock exchange for the investors, they are told that it's you are playing around with the price movement of the subsidiary company through this unlisted holding company, and therefore a huge penalty was levied on the unlisted holding company as well as the subsidiary company, that how could you permit. So it was an unlisted holding company in the same line of business, but all the material information with respect to that, it was being put up on the website, and this thing which is actually the official website for the subsidiary, where the annual reports of the subsidiary are, etc. are available. So, the indication there by the regulator was very clear. You de-link your two websites. So, don't disclose your unlisted holding company's information on the subsidiary company and try to do a price manipulation of on the stock exchange through all these information, when it's really not impacting the subsidiary company, because the businesses are being, and the unlisted holding company has only the few shareholders or the promoters, etc. So who are actually sort of benefiting also because they are shareholders in the subsidiary company as well. So the price discovery. So that was, the information on the group or company's website could be an indication, but how related party transactions are being viewed by the regulator, this is good. So any unusually long credit period or interest-free loans or guarantee arrangements, etc. Historically, we are all aware that there are a lot of these corporate guarantees holding to subsidiary and all these guarantees which were there in place. Last year, the GST department put it to rest by telling that 1% of the guarantee amount has to be, it's a taxable supply, and you need to collect guarantee commission. So earlier there were always these debates under the erstwhile excise law, indirect tax law. Income tax department historically in transfer pricing, when it has been provided to an international holding company or international subsidiary, the income tax transfer pricing officers have always contended that you need to get a commission in India for the guarantee provided, or if it's a guarantee received, obviously the officers will be silent because they don't want you to pay, because you still tax. But if you end up paying, they don't challenge much unless it is not at arm's length. So typical guarantee arrangements under when it was an AS environment, or even prior in the GST era, in the GST environment prior to this October 2023 circular, there were a lot of companies who were not charging this. Under Ind AS, it was told that as much as possible, if guarantee commission is not being charged, etc., then treat it as a deemed investment in your subsidiary and do a notional Ind AS 109 computation. The guarantee giver has to factor in as part of his expected credit loss. So if the subsidiary defaults, then, or to whom I have given a guarantee, if he defaults, then it ends up in me. It's an off-balance sheet item, but for your ECL model, expected credit loss provisioning, you need to factor in your guarantees provided as well. So that's there in Ind AS. It also told that if you're not charging, then it's like a consideration which you are giving. Treat it as an investment. So your investment in your subsidiary will keep every year including to the extent of a notional guarantee charge amount. Methods are prescribed, etc. But the positions are becoming little more clearer with respect to guarantee accounting and this thing, both under GST and Ind AS. Earlier there used to be ambiguities. To that extent, guarantee arrangements of balance sheet items could typically indicate that you will generally not provide a guarantee for an unrelated party. I mean, if you are providing a corporate guarantee or a personal guarantee, etc., if the director is providing, then it could typically be indicative of a related party transaction or an related party relationships. Common assets and costs. So, same building, group entities there where the promoters are owning. It could be a listed entity and a promoter-owned private limited company. You will typically find the finance team and the secretarial team being the same. The listed company's finance team and the secretarial team will do the jobs of the promoter holding company as well, and there will be no flow of consideration at all. GST department is anyway disputing that separately. But from an audit perspective, these are indicators which are provided that common assets or costs which are not being apportioned, etc., has to be factored in as a significant risk as part of your audit. So, significant risk and fraud risk indicators which could be typically there in a related party transactions: borrowing or lending on an interest-free basis. Selling, of course, borrowing or lending on an interest-free basis. Section 186 in India prohibits. You have your Companies Act, and as an auditor, you are anyway required to report intercorporate loans and investments. Even wholly owned subsidiaries, while they are exempt from the limit, that 60%, 100% computation cap which is provided under Section 186, even wholly owned subsidiaries are not exempt from the requirement of charging an interest. So that is anyway required. There are a few exemptions subsequently, like for banking, NBFCs, and then infrastructural facilities, etc. But typically an interest-free loans, etc., we still find, despite 186 violations which an auditor is supposed to report upon in his CARO, we still find that in a lot of cases interest-free loans are provided, which would be indicative of related party transactions, because you would generally not give on an interest-free basis to a third party. That's the general assumption. Selling real estate at prices that differ significantly from appraised value. Exchanging property for similar property. Doing a barter transaction sort of thing. Non-monetary transactions. Loans with no scheduled terms. Loans with accruing interest significantly different from the market rates. You charge hardly 2%. and you don't do interest free. So 186 you are coming out, but again in 186 they also state the interest cap, that minimum government yield. You are around that, but your cost of funds you are raising at 12% from banks based on your credit rating and something, and you are lending at 8%. That could be indicative of related party transactions and also not being at arm's length, etc. Loans to parties lacking the capacity to repay, loans advanced for written off subsequently as uncollectible, non-recourse loans to shareholders, agreements requiring one party to pay the expenses of the other, round-tripping sales arrangement. You go to the buyer, you say I will sell it to you, after some time you sell it back to me, it's just a temporary arrangement. Business arrangement where the entity pays or receives amounts at other than market rate. So these could be indicatives of related party transactions and relationships, which has to be seen critically from a significant risk factor or a fraud risk factor. Again, just to clarify, it's not necessarily that it is a fraud risk. Evaluate it from a fraud risk perspective is what the standard is trying to say. You may still conclude that it's not. And one thing which has been told is if there is a dominant influence of the related party, where, in Hindi they say that उस related party के बिना पत्ता भी नहीं हिलेगा. Nothing will shake without the related parties. Even he has to nod his head for every Tom, Dick and Harry aspect of the transaction or the business. Then it could again typically expose you to the larger risk. Sometimes, of course, any entity will have a promoter, related party, all that. No one denies that. But if the management is left to an independent professional management, the chairman is a promoter who is a non-executive person who comes only for the board meetings and the shareholders meeting, but the management is completely left independent to the CEO, to the MD, to the CFO, etc., and not the day-to-day interference is not there, then the risk factor is lower. But if it's, there is a poking nose in everything, where the CEO, CFOs, and then typically this could also reflect in the attrition of senior management personnel, because generally you will see that wherever there is a large promoter interference, the attrition of the senior management would be high, because they would, obviously their ego will get hurt. Why is every aspect of me being challenged? Why is every decision of me being looked at, etc.? So you will find that the attrition rates will start increasing at the senior management level. That's also given as an indicative factor both in SA 240 and in SA 550. So to that extent, if there are dominant influence by the related parties, again they have given us few examples. The management or the board has decided something, but the related party being a major shareholder or something, he vetoes the decision. He does not allow it to pass through. Any significant transaction are referred to the related party for final approval. There is no debate amongst the management, as I told, bulldoze through the decision. Anything decided by the related party or related to the related party, ensure that it passes through any major discussion or brainstorming without any major discussion. That could be an indicative of a dominant influence by the related party and therefore a fraud risk factor. Transactions involving the related party or a close family member, and the related party has a leading role in founding the entity and continues to play a leading role in the managing. So of course you will find that in the initial days in startups and this thing, you will find new company being founded, the promoters will be involved on a closed basis. But once the rounds of funding and etc. starts coming in, you will have professional managements being there. Yes, the key person will be as the CEO, but they will not be able to decide anything. The private equity investors, as part of their SPA or the SHA, the share purchase agreement or the shareholders agreement, will include clauses which will say that these decisions cannot be taken without their concurrence and all that. So how much is the lead role and how much is the decision making power or the veto power of the founder or the promoter or the related party restricted or it's unabated? So as I told, unusually high turnover of senior management or professional seniors, use of business intermediaries for significant transactions, related parties excessive participation in selection of accounting policies. Why don't you account this in this manner? Why don't you present it in this manner, so that the share prices are kept under control, or the price earnings is taken care of, the tax part is taken care of, etc. So if someone is very closely and determining material accounting policy, which may not exactly be in sync with what is actually required as per the standards or the general industry practices, etc., it could be a indication of that person is related party, or is having an influence in this thing, and therefore exposing the entity to a fraud or a significant risk. So what procedures as an auditor, they've provided an indicative list of procedures which you could perform. For an identification, I dealt with earlier in terms of this thing, but to see from a fraud risk factor and to see at the arm's length perspective, identification will go through the declarations, the websites, the annual reports, and those sort of things. From an influence perspective, it's independent discussion with the intermediaries. So if there are banks, law firms, etc. who are being engaged, agents, etc. who are being engaged, then you have independent discussions with them as part of your risk assessment and as part of your substantive testing. Specifically, generally we send a receivable payable confirmation, but to a related party or someone, can you send something like a key contract terms confirmation? So you can customize asking them to confirm the substance of the transaction, asking for the economic rationale of certain transactions. Of course, again going back to one principle which has already been told is, a confirmation from a related party is always lesser reliable, but it does not state that you need not, it is not at all an audit procedure, or it's an invalid audit procedure. View it skeptically, but you can send specifically customized confirmations to related parties. For example, normal receivable payable, you would probably just send only the closing balance, but to a related party you might send transactions, closing balance, and maybe ask him to confirm if there is any off balance sheet item like a guarantee or a common cost arrangement or something like that. Considering the financial and other information of the related parties, loans have been provided, you have a look at their financial statements, whether the net worth is positive, whether they are doing business, cash flows are there, EBITDA positive, PBT positive, cash flow from operating activities are there, not there, whether they will be capable of repaying the loans, etc. So not just going based on a management assertion that loan recoverability, you typically perform procedures based on the financial and other information. Again, just to give back an example from the same coffee day order where the auditors were challenged, was one of the group entities. They had just furnished a net worth certificate certified by an independent chartered accountant, telling that the net worth of the other entity to whom it has been lent is this much. And the regulator came back and told, have you really seen that the auditor is independent of that entity? Have you performed your SA 610 procedures around the management expert procedures? Have you yourself seen the financial statement, or just taken the certificate and kept it in your file and closed it? When the amount was so significant, it was almost 50% of your balance sheet size, etc. You need to exercise that additional skepticism from a related party transaction perspective. So these were, considering the financial and other information on a skeptical basis, inquiries with the management, inspection of contracts and other evidences, background checks around those relevant parties or the directors of the thing. You do have professional independent agencies who will do background check discreetly. You can approach them, and of course they will charge you a nominal amount or something, but as an auditor, if you feel that the risk element is high, you can approach such independent background check firms also. They do it and they will give you a, they'll pull out, they'll do the entire ROC filing, and they'll give you a formal search report or something summarizing their this thing, they will view their independently available sources, GST database, any case is running in any portal, etc., and they will provide you a formal search report as an auditor. In case you don't have that much of time to spend, you can at times engage your expert to perform these background checks. Internal audit reports, whistleblower complaints, orders of statutory authorities like transfer pricing officers or the income tax department or the special valuation bench, etc. So undisclosed related party transactions, of course, has to be evaluated as a fraud risk factor, and the auditor is not supposed to, the standard provides for it very clearly that it is not just the validity. The management has identified 10 parties and the transactions with those 10 parties are being summarized. That's alone not what is required. You need to confirm the completeness. It's normally there for any other thing, but for our related party transactions, it's all the more specifically emphasized. Again, going back to one of the examples, and where the transactions are being summarized, we saw one procedure that one needs to see the process of identification and summarization and reporting of the transactions. As simple, companies, when they summarize the RPT transactions, if they are going based on the vendor ledger, which of course has the net of TDS amounts, but you are supposed to disclose in your RPT transactions the gross of TDS amounts. Legal and, the entry could be legal and professional charges 100 to TDS 10 to vendor 90. Now if you are going to take the vendor ledger and see the credits and then summarize it, you might end up summarizing a wrong thing. So therefore, what is the process around summarization of the related party transactions? So what could be, if I have a customized report in my ERP, well and good, which like a purchase register or a service register or an expense register which gives me the base amount, GST, total, TDS, net amount. If I have such a customized report, well and good. If not, some workaround. Take the vendor ledger, take the voucher number or something, and manually say put a VLOOKUP or a pivot or you call whatever Excel tool and take back the base amounts from the expense ledger. Is that being done? What is the summary? And if it's being done manually, of course we know things, automated controls are more reliable, manual controls needs to be tested little more in detail by the auditor. So these are those typical process level understanding which you need to get around related party. The standard will only provide, as I told, high level principles. It will say understand the process and understanding. It is up to the professional judgment of the auditor that how does he interpret that and how does he apply that in a real time scenario. It could change on a case to case basis depending on the flow of entries or in a similar SAP environment I have seen two setups where in the example in which I gave, vendor ledger being credited with a net 90 amount and the same SAP environment, vendor ledger credited with 100 and there will be an auto debit entry which will record a 10 rupees immediately on the same date. So you have a 100 credit and a 10 debit which will transfer it to TDS receivable. That gives you probably a larger comfort. So evaluation of the process and the controls is what would be very critical and crucial from a related party transaction summarization perspective. I think it's a break time for 15 minutes, 11:15 to 11:30. We'll again resume back for the balance half of the discussion. Resume back. And what are the audit procedures and others?
Before we start, I have a question.
Yeah.
See, all that which we are looking at is for a very large organization. Of course, it will be a similar impact even if it's a smaller organization. But I have a scenario where there is a common director in 5 private limited companies. And all the 5 private limited companies don't fall under the CARO category.
So none of the private limited companies have the CARO reporting aspect. Now, since the director is a common director,
what is it that I actually have to look at? And if I say that there is a related party transaction between the private limited companies, not per se with the directors, so what sort of reporting I need to look at? As I'm repeating, they are not falling under the category also. So what should I actually look at?
So SA 550 is not only in a scenario where audit CARO is applicable. So these are general audit process which you have to follow for your overall financial statements audit. That's the first thing which has to be kept in mind. And it provides principles in terms of how do you assess fraud risk, how do you assess a significant risk, etc. Now, in a private limited company transaction, so if there is a typical, for example, one company is making very good profits and the other company is into losses, and you ask the loss company to raise an invoice on the profit making company, this is more to suppress the profits there, because you'll end up paying tax in one entity and you will not have a utilization there. So this is a typical transaction which happens in private limited companies where there are common directors. So they will say that this thing. From your perspective, you have to see that, okay, are there actually, is it a genuine transaction? Is there goods and service which is actually being received, not received? And you can still test it from an audit perspective that it is, whether the prices and at which it is being done is fair. Otherwise, if you are the auditor of one entity and there is someone else is an auditor, the entity in which you are impacted, it could also be that you might have to look at your true and fair view, because that is anyway there. That's always there. A true and fair view reporting on the financial statements is always there. So, not necessarily CARO, which explicitly states arm's length, section 188, but from a general, as I clarified to ma'am also, that you have to look at it from a true and fair view perspective. And if your profits, your revenues or your this thing are getting diverted, or this thing in that entity in which for which you are reporting would typically be impacted through that consideration, where your revenue is inflated or your costs are inflated, your profits are reduced, your tax expenses therefore reduced, and so therefore from a judgment perspective you have to evaluate there that whether your financial statements true and fair view is really impacted or not.
Say suppose all the 5 entities are entirely independent in their transactions. That is, their operations are not overlapping. The business is totally different sectors. And say suppose one particular company, as you rightly pointed, one is a profit-making private limited company, and they are trying to handhold the rest of the private limited companies in which the director is common by just pumping in funds for their operational activities. So in that case, it's almost like a loan that is getting transferred from one company to the other private limited company. So in that case, what sort of reporting we need to do? Since it's just a common director, but the transactions are entirely independent.
So now, if you see, for example, Companies Act, section 186 is not exempt for private limited companies, irrespective of CARO reporting or not. So if there is a 186 non-compliance, then you have to see from a judgment. The second one, you will look at the recoverability of loan perspective. Okay, in the company in which you are reporting, that again impacts your true and fair view, because you are reporting on the balance sheet P&L. If the loan is not recoverable but you are not providing for it, then your true and fair view is again impacted. Interest rate, if you are not charging, there is a section 186 non-compliance. 186 non-compliance is non-compoundable in nature because it says fine. Fine and imprisonment. So under Companies Act, you have these provisions where you have penalty, or imprisonment, and you have fine and imprisonment. So it's a non-compoundable offense. So to that extent, there's a risk exposure. There's a huge penalty on the company, and very interestingly, if you see the company law committee deliberations, they told there were representations that 186 should be exempted for private companies. But the company law committee, during the amendments, they told that no, 186 will not be exempt for private limited companies, it will continue to be applicable. So they gave some exemptions in 188, some related party transactions not applicable for private limited companies, etc. But 186, no exemption was given. There's some of few indicators which you have to look at it from this perspective. I mean, it's obviously case to case, and you have to see always from a audit perspective and a true and fair view perspective. Reporting under CARO is secondary. So what we are discussing in SA 550 is not why if we have to report in Caro alone. This has to be generally performed. So, to go back. Yes. Yes, sir?
Can you describe difference between significant influence and
Ah.
significant control? There are two aspects. Hello. This significant influence is not been defined. Significant control has been defined in the Companies Act. But he says that everywhere he more emphasis on significant influence also. So, what is your opinion on that?
The Companies Act was amended in the context of the definition of associate. They amended and told that significant influence in two manners. One, if you are having 20, that's now there in the Companies Act. Earlier it was silent, but now it's there that 20, the general threshold applied is 20% or more of the voting power. So if you see Income Tax Act, they don't have any concept of control at all. They will deal only with substantial interest, and for them anything more than 20% is a substantial interest. The wordings in Companies Act and when you go to Ind AS is significant influence, they have two types of thresholds, 20% to 50%. Significant influence, 50% and above, that's 51% and this thing. It is a subsidiary. That's where you have a control. And an absolute control is anyway 100%. So generally 51% or more of the voting power is control, 20% or more is significant influence, but I have also told that there could be exceptional scenarios where you have despite lower than 20% board seat or participation in some key decisions, like if any further investment has to be made or acquisition has to be made or a divestment has to be done, the approval of so and so person is necessary, or any key borrowing or expansion or so and so. If that has been preserved despite being lower than 20%, you still have to determine that as a significant influence. So not only legal, one also has to look at the contractual rights. And when there is some investor or someone on the board, you really have to see the SHA or the SPA, the shareholders agreement, the share purchase agreement when an investor has come in. It could be an individual investor who has, or a strategic investor or a private equity investor. So these could be, legal and contractual, both has to be seen together. Of course, we know that the contract cannot override legal, but if the contract is in addition to legal, then that also has to be factored in for significant influence perspective. And control more often than not 50%, but there are cases where, you will under Ind AS, Companies Act 50% or more, 51% directly, but Ind AS has a small caveat that you can disprove. It is a presumption that you have control, but you can still disprove that you don't have a control if you have like a joint venture agreement, like a 51-49 arrangement, but no decision can be taken by the 51% guy individually at all. Then it still has to take the color of joint venture only under Ind AS, and therefore you will still do your accounting under the equity pickup method only. You will not do a line by line consolidation. So, of course, as I told that, the related party gamut and this thing is quite complex at each. Companies Act is different, Ind AS is dealing with differently, 40A2B. So, depending on the reporting scenario and framework, one has to look at the relevant framework and then decide on these things.
What about board voting?
Board?
What about board composition?
Ha.
The board composition, the power is more than 30%. There are only 3 directors.
Okay.
The director is having lesser holding, but he comprises of 1/3 of the quorum. What is the situation in that?
So that 1/3 of the quorum can still not necessarily emphasize, on a control per se, and neither a significant influence, unless it is agreed as part of the articles of association or as part of the shareholders agreement that these 10 decisions has to be only unanimous. Then yes, you have a significant influence. Or at points of time, then you can also say that it is a joint control. So a joint control will then necessarily mean that all 3 has to do a JV method of accounting. But it really depends on those things that and if at all any decision can be taken by majority, then that one, despite having a board representation, will still not be determined to be a significant influence, because it can still be taken by majority, and my holding is anyway less than 20%. So at both the places I am getting defeated. So therefore no significant influence at all.
Consolidation may not be necessary at that point of time.
Which one?
Consolidation of the accounts, of the financials.
Yes.
So if the percentage of holding is about 20%, and the influence as well as the control, both of them put together is not there. So consolidation of financials is not necessary.
Yes, but more often than not, you will rarely find that more than 20% but influence not being there is a rarity. But if that's the case, yes, then you don't still have a consolidation. Even your associate equity pickup method accounting, you will not do it.
Because this influence as well as control, they say and. So both of them put together should be there, so that influence and control and
no, for consolidation purposes, if you see AS 21 will use the word, I mean, if you have to see from an AS perspective, and similarly in Ind AS again, AS 21 will use the word control, AS 23 will use the word which is associate consolidation, will use significant influence. When you come to AS 18, related party transactions, there it will use the word influence or control, that is only for the purpose of related party identification, and this thing is disclosure. So AS 18 and Ind AS 24 are disclosure standards. They are not accounting recognition and measurement principles. They don't deal with that. For your accounting recognition and measurement, you need to go to So for accounting and recognition measurement principles of this thing, you need to again go back to this thing. For example, there's a classic case. I'll probably have to very quickly, and then I'll again have to go back to the standards. In Tamil Nadu, you have this typical arrangement of captive power where you need to minimum have a 25% investment for it to be classified as a captive power unit. That's the central electricity TNERC rules, etc., which says that you need to. But if you see the shareholders agreement when they enter, and I have typically just seen in 3 cases very recently, the shareholders agreement will say that the guy holding 25% will not have a board seat, will not have a right to receive dividends also. And voting power at the shareholders meeting will be there, but he has to vote only based on what the other 75% is instructing. He is the windmill operator or the solar operator or this, and you are actually going to him for captive power for the limited purpose of satisfying the TNERC rules, that's the Tamil Nadu Electricity Regulation Commission rules and the Electricity Act. You need to do a minimum 25%, only then it will be classified as a captive power and you will get the credit in your TNEB bill. This is a very classic case. It is there in Tamil Nadu. Many corporates are entering into large captive power arrangements. You will have 25% investment, but you will not do a consolidation accounting account because you don't have a significant influence.
In this case, there are 3 directors. One director is common. He is a director in both the companies. The company is holding some 8 to 9% of the other company's shareholding. Together with the directors, it has more than 20%.
But still, from a legal, that's why companies you will see that from a legal reporting perspective, consolidation would not be there. Yeah. And but you will typically have when they go for investors, if they are pitching into investors or bankers or something, they'll do a management consolidation, internal management consolidation, and depending on the banker or the investor, if he says you give me a special purpose audit report or something, they'll go to an auditor, get an audit report and give it. That's only for the limited purpose of giving to the banker or investor. A legal consolidation would still not be applicable.
Thank you.
So, I mean, going back to the audit procedures of this thing, of course, from the auditor perspective, it's a communication or discussion with the engagement team, which has to be done with respect to the fraud risk related party assessments. Consideration of materiality is one of the factors. Of course, it's pervasive. I mean, you have to be worried or this thing only about material transactions and balances. Impact on the company's controls. Additional risks, if any, to be identified. What's your conclusion on controls testing? Impact on reporting on ICFR, if ICFR reporting is applicable. And how the controls around these related party transactions, recording, processing and summarizing are. risk of possible non-compliances, you have a separate standards on auditing consideration of laws and regulations in the context of this thing, and there if you assess any non-compliance per se, then are you supposed to report upon it? The standard again, now we have these additional provisions of NOCLA, non-compliance with laws and regulations, etc., which has been prescribed as part of the code of ethics. So there again, you might have to assess non-compliances in the context of NOCLA also. Control reliance strategy, after you assess it, if the controls are weak, can you really rely on the controls? These are certain audit decision factors which you have to take at the relevant stage. And then conclusion and reporting. One, whether you have to report it to those charged with governance, just as the director, the presentation which you make to the audit committee or to the board, etc. Or do you really have to consider it as part of your audit report? Again, is it only CARO reporting or audit report? So take your decisions on the relevant conclusion and the reporting aspects. So,
sir, what is the importance of mentioning materiality here? What is the importance of mentioning materiality here?
See, obviously,
even though it is not material, we have to disclose certain things.
Disclose is one, but are you worried about it from a true and fair view perspective? So as I was always telling, disclosure is financial reporting aspect to a couple of questions which came to me. But the auditing standard is more for your general audit, even if you don't have a specific reporting. The standards is providing principles that please assess fraud risk in the context of related party, please assess significant risk. And obviously in any audit scenario, you will be worried on a true and fair view perspective. The auditing standards are not for your CARO, the auditing standards are not for your in-days disclosures. For that you have to go back to the standards. This is SA 550, which prescribes principles for your true and fair view state of affairs of the audit. So there, of course, materiality will take an importance. So if you are looking at it from a true and fair view perspective. Few methods, of course, as I told, the arm's length principle. Again, there are two things which needs to be remembered with respect to arm's length. If your financial statements reporting framework, Ind-AS does not require it. Globally, in some countries, there is a specific statement which is required by the management that the transactions are at arm's length. In such a case, then the management the auditor has to obtain evidence for that because it's explicitly stated. If not, currently in India, your financial reporting framework does not require an arm's length assessment, but your company's audit reporting framework requires. So again, it does come in. There could be a small interplay. Just to give an example, associate of holding company is not a related party under section 188 of Companies Act. So I might not test the arm's length. It is a related party for the purpose of Ind-AS 24. So if a holding company has invested elsewhere 20% or more, an associate of holding company is a related party for me. Transaction will be disclosed, but I don't give an explicit statement that it is at arm's length and in the financial statements. So therefore, as an auditor, I am not obliged. While as a judgment I can, but I am not mandatorily obliged to take an arm's length assessment. But if it's a subsidiary or if it's a direct associate, it is covered under section 188 also. So CARO reporting, if applicable, I will anyway have to consider the arm's length principle. So there could be some interplay around this, but the general principle which the standard provides is arm's length evidence to be obtained only if there is a specific assertion in the financial statements. It seems globally now it's not there, but earlier there used to be some jurisdictions or countries which used to say that only transactions which are not at arm's length have to be reported. So if I am having 10 transactions, if I am reporting only 2, in India you are supposed to disclose everything, but globally there are a few countries which have only, you have to disclose only if it's not at arm's length. Now if it's not at arm's length, if I disclose those 2, that means the balance 8 is at arm's length, and that's also required to be tested. I mean, the auditor has to obtain an evidence for the arm's length. So whether you need to really test it for arm's length or not, and arm's length again method is not prescribed. You will obviously, if you are in an India setup, you will fall back upon, in India for arm's length, you have only a valid framework is the Income Tax Act, where for international transfer pricing they are prescribing methods, cost plus method, comparable uncontrolled price method, or you will see the margins of your margin versus the comparable company's margins, so on and so forth. But otherwise, though the Companies Act uses the word arm's length, or Indians might use the word arm's length, etc., there is no specific guidance which is provided under this, so you will have to draw analogy obviously only from any other applicable framework. So that's why I've just listed down what's provided in Rule 10B. This is not part of the standard. Standard does not give a cross-reference to Rule 10B of the income tax rules. But if it is arm's length, these could be some of those methods: cost plus method, retail sale price method, transactional net margin method, etc. You might have to evaluate the management's process of fixing the price, evaluation of arm's length, assessment of the appropriateness, etc. How is the management actually fixing price for its related parties? If there is anything, it could be a loan transaction, goods, service, or any other transaction, sharing of common cost, etc. And what is it that, test it for accuracy, completeness, and the relevance of the disclosures. What are the reasonableness of the significant assumptions? For example, I told in the context of guarantee, you have to consider it for your expected credit loss model. So if you are given a guarantee under Ind AS, under IGAP, you will not do a provisioning for an off-balance sheet item. Though it is a good financial reporting, IGAP does not prohibit, but it does not explicitly state that either. But if you come to Ind AS, you will say explicitly that even off-balance sheet exposures if you have, and it could result in a credit loss for you, please consider it as part of your business. So you will have your assumptions and estimates. It's an area of significant management estimate, etc. Again, Ind AS goes back to your detailed principles of probability of default, PD into loss given default and exposure at default. So these are all management estimates which you need to factor in. So evaluate the reasonableness of those management estimates, if any, in terms of the transactions. And for example, if there is an allocation of common cost, there is a corporate level cost and that is getting allocated to various related party entities. What's the basis of that? Do you have time spent? If the CFO is common, group CFO, do you have a rough estimate of the time spent? Is there a time sheet? The answer might be no. Then is it being allocated on the basis of revenues of each individual entities? So you need to probably, those could be some significant estimates and judgments. It's not a clear, straightforward transaction that you have sold something and you got the money. There could be estimates and assumptions involved, and therefore that would have to be validated or reviewed. So if there are assertions with respect to arm's length, you have to compare the terms and pricing with identifying similar transactions with one or more third parties. So if you are selling the same good or with slight modification or customization, that's your comparable uncontrolled price method as well under the Income Tax Act. But this is something, a generic principle has been indicated under the standards as well, that if you have to test for arm's length, this is something which you can do. Consideration of information in relation to open market price. For example, if you're selling a real estate property to a related party or something, guideline value or a market value, if it's estimated to be significantly higher or lower than the guideline value, then you see for a nearby property. But then again, you might factor that in for the customization. For example, a corner property always is expected to have a higher value than a inside the street property. So you might have to do an adjustment for seeing that some arm's length, some estimates, etc. But market prices could be available. So that could be some basis for this thing. At times you might have to engage management experts or auditors experts to see the arm's length principles. As I also told at the start, for reporting under Section 188, at times you might ask the company to engage an expert to get a reporting on that. Transfer pricing regulations are anyway there, and that again is determinant on your materiality perspective and how much you are able to negotiate and convince the company. If at all it's not mandatory required, but you still need it for your audit comfort. So some possible ways: standard list, pricing policy, what's the market price of the goods, comparison of gross margins with similar third parties, comparison of the margin. If you are not selling it to a third party, you are completely selling it only to related party, but there is some other company which is selling a similar product to a third party, do you have a comparable price information which you can use it? Under transfer pricing, you have safe harbor rules which provides that generally these nature of industries, it's better at least bare minimum this much of, you may opt for it, and if that's achieved, then you generally consider that to be at arm's length. So something similar you might have. I've just given some examples of how an arm's length could typically be seen at, but again it goes back to the basic premise. If only you are required to report on arm's length, whether as part of your financial reporting framework or as part of your audit reporting framework. If you are required to report, then perform these procedures. So leasing of premises, few examples I told: market rent for similar building. This could also apply, for normal real estate sale, a property sale transaction also, or a leasing transaction also. What is the annual rental value or the guideline value which is fixed by the local authorities? That could be a determinant or indication. And at times it could be, engaging a market surveyor or, some chartered engineer or someone to sort of assess the value. Corporate guarantee, again it depends on, what is the credit rating of the opposite party to whom I have given the guarantee. How much is the risk exposure for me? Obviously, higher the risk, you will charge higher amount. Lower the risk, if it's a very stable and operating company, then you might charge it for a lower amount. GST has fixed the bare minimum 1%, but if you compare it with the market rates, banker's website, if you go, similar guarantee, if a banker would have provided, it would have charged a 1.8%. So bankers also do provide guarantee. Customs department will say that go and get me a bank guarantee, or the GST department would say go and get me a bank guarantee, and the bank guy would charge you a commission. Listen, that could at times be indicative of what you should charge for a guarantee given for the obligation of a related person. So even on the lot of the bank websites, you will generally find up to 10 crores, 1.5%, 10 to 100 crores, 1.8%. So charges is generally available publicly also, so that could be one of the indications. You might have to adjust it for the credit and the risk factors, but some indicative methods through which this thing. These examples, again, I'll clarify, this is not part of the standard. This is something generally followed, good audit practices, and maybe some of these are obviously stated in the income tax as part of the transfer pricing, which, as I told, the analogy can be extended.
So, how to establish arm's length price for dividends? For dividend,
you never have an arm's length. This thing, it's your residual profits which you are distributing to the shareholders. You don't have to establish dividend arm's length for dividend. There is no requirement anywhere that you have to establish. You just have rules under the Companies Act to state when you can distribute dividends and when not. If you are a loss-making company, then ensure that you have these approvals, or you restrict your dividend payment to so and so. Those restrictions are there, but it does not say that evaluate it for arm's length. Or if you have inadequate profits but you still want to declare higher, then there are certain regulatory restrictions you need to follow, but for dividend you don't have an arm's length principle. Because it's your residual profits. So what impact your profits or something is what has to be seen. At times as an auditor you could probably question, you have repatriated dividends, but is it something you have declared huge dividends, post that you are going for an expansion and then you are taking borrowings. So you will as well say that you could have as well retained the dividends, but there again it depends on an arbitrage. It's generally told that the cost of equity is higher than cost of debt. Because if you are a stable company, larger companies, the expectations of dividend, because they are stable, the expectation of dividend is always high. So that's why in your capital market principles you have cost of equity. But cost of debt, one, it could be lower, two, you will get a tax benefit. So there could be decision making factors, but that's something really separate. It is not to deal with arm's length. And that best said, I mean that's left for the CFOs and promoters to decide based on the cost factors and alternative deployment principles. Business rationale and substance of the transactions we have discussed, key terms and conditions to be evaluated, effect on the financial statements including disclosures. Again, in disclosures we really find that there are multiple ways in which companies disclose. Some disclose each related party every transaction. The standard provides an option which various large groups take it. You disclose it at an aggregate level, total sale of goods to all subsidiaries put together. And if any single subsidiary is crossing 10%, then you disclose the name and the amount. So I could disclose probably sale of goods 100 rupees to 5 subsidiaries or maybe 20 subsidiaries put together, but out of that one subsidiary is crossing 10 rupees. So that alone I have to disclose the name. So an aggregation is also allowed. It's a choice which is given, but you don't have that choice when you come to section 40A2B Income Tax Act, or when you go to 92A, I mean transfer pricing 3CB, you don't have those options. You have to disclose a party-wise details only. But in your financial statements, how do you disclose, how do you aggregate, how do you disaggregate? It could be some of the principles which you could, as an auditor, you might want to verify. Hidden cost and off-balance sheet exposures. So, written representations have to be obtained for identity, appropriate accounting and disclosure, key terms and conditions in respect of the transactions, consistent and need and benefit, and the actual utilization in the case. These are certain written representations which you can obtain as part of a management representation letter that this is the economic substance of the transaction, because obviously in a financial statement or audit report will not give the complete story. In your internal documentation as part of your working sheets and as part of the management representation letter, it is suggested that these aspects are obtained. I touched upon a few of them. I mean, I discussed about this NFRA order, Coffee Day, where the auditor was expected to challenge even the professional skepticism despite the audit committee approval. IL&FS, they questioned on the evergreening of transactions, loans continuously given, after which you had the CARO 2020 clause being brought in after the IL&FS failure in 2018. You had in the CARO 2020 disclosure with respect to evergreening. Evergreening, you keep giving a loan, show it as a repayment, then again a fresh loan given. That is to avoid any provisioning or this thing, so you keep greening up the loan. So there were some, and that's particular in the context of related parties, the regulator had come down hugely. This was another one where from a section 188 reporting, CARO reporting perspective, the regulator commented that there was no assessment of arm's length assessment by the auditor, and there was no evidence of that in the file. IPO proceeds, a lot of these the company had gone for IPO. The IPO proceeds were used for payments to related parties, and under SEBI ICDR specifically, the end utilization of the IPO proceeds etc. has to be tracked, reported upon both by the credit monitoring agency as well as with the statutory auditor by the year certificate. That was not adequately evidenced in terms of what the end utilization, just a listing of payments alone was available. That's something which the regulator came down. And one of the cases, they did a review of the financial statements, not the audit report. So NFRA has, there are 3 things which they do. They release orders, they release audit quality review report, and they release a financial reporting review report, FRQR. So this is something where they released a financial reporting quality report, and they told that the loan amount was disclosed, but the section 186 disclosures in terms of rate of interest, collaterals, terms of repayment, all those things have not been disclosed. That's not part of Ind AS, but that's part of your Ind AS just says, okay, the transaction or the balances alone can be disclosed. But these additional disclosures for loan transaction are provided in section 186 of the Companies Act, where they say that the terms, and that was not disclosed, and therefore it was found to be non-compliant with the Companies Act. That was a comment which again the regulator had given. So some of the principles which we have, tried to cover the standard with this thing. So there's a small, I'll just zoom it. I'll leave it with the institute. This is something which summarizes. It's like a model audit program which can be followed for, it effectively summarizes, and then this is like a sort of checklist. So at the planning stage, what do you do? Obtain the relevant client schedules, and then how do you review the completeness of the information provided? Various things, review of the minutes of meeting, whether you have done the shareholders records, other loans and payable documentation, investment transactions, and all this unusual transactions, how have you gone through? Related party transactions and disclosures, grouping, whether transactions have been grouped adequately, aggregated adequately, whether the header of the transaction explains the nature, and things like those sort. And then obtaining, one is the MRN, the second is if there is a declaration which is required to be given by the director, then that. And then finally the conclusion and the reporting. Sometimes, a lot of times you also have to see that, these valuations and this could at times not just CARO, it could also become at times a key audit matter also. So if you are doing the audit of a listed company, then you might have a CAM reporting which will form part of your audit report. So you would have to give those, a typical related party transaction might very significant and material might become CAM. So you also have to assess from that perspective that whether it's a CAM, whether the estimates, assumptions, management experts, challenging the management experts, reviewing their inputs, reviewing their assumptions, all those things, etc., have also been sort of taken care of. So I'll wrap up my session with that. Any one or two questions? I think we are almost on time. Any questions? Thank you.
Thank you, sir. Thank you for your valuable insight on the topic of audit of related party disclosure. Thank you very much, sir. I oddly welcome Ashwath Subramaniam, sir, to occupy dais. It's my pleasure to introduce Ashwath Subramaniam, sir. He is a practicing chartered accountant over the 6 years of experience. Have led gap conversion engagement in India for clients across various sectors like power generation, real estate, and manufacturing. Have assisted companies in preparing and submitted group reporting models in line with IFRS, and taken transfer pricing engagement for companies across different industries. Managed, led statutory audit and tax audit engagement for clients in India across various sectors. Managed internal audit for large clients in India across the manufacturing sector, software and hospitality sector. Have involved in supporting clients for preparation of financial statement in GAAP and Ind AS, audit support and tax audit. Be a part of major accounting engagement for leading hotels. Managed and undertaken GST audit and return filing engagement. Provided outsourced CFO services for NBFC and technology startup. Assist in preparation of prospect document for companies getting listed on stock exchange. He has specialized in income tax, particularly international taxation and transfer pricing, and regulatory engagement and gap conversion engagement. Thank you, sir. Thank you once again. I request Veenaa sir to present the memo to the speaker.
Good.
Hand it over to the speaker.
everybody. I'm Ashwath, and I would like to thank, at the outset, I would like to thank SIRC for the opportunity to speak to this August gathering on the requirements of related party disclosures as per the Companies Act and as per the accounting standards. Now, I must admit, I have also gone a little further than the stated topic. I have also included additionally the requirements of the disclosure under the listing regulations, under the SEBI lot of regulations. Okay, so in a very brief the session would be moving in this sense. That is, we will start with who are related parties, what are related party transactions, what are, in very brief, we would also be covering what are the approval mechanisms with respect to related party transactions under the Companies Act and additional requirements under the SEBI regulations. And finally, what are the disclosure requirements under the laws and regulations that we are going to look at. So in very brief, this is how we are going to take forward this session. And I must say, although it's lovely to be speaking here today, I am in a very tricky spot. We are at a time where our tummies will start to growl, and after our lunch break, we would want to have actually a good nap. But let me try to see if I can keep all of you awake. I would request the same from you as well. So, moving on. To start with, let us first look at who are related parties. Right? Now, this term, related parties, like I was saying, there are several places where we are going to see this word. Where on? You would see it in Companies Act, under Section 2, Clause 76, under the SEBI Lot of Regulations, which is where the related party term is defined under Regulation 2, Subregulation 1, Clause ZB. Then it is also defined in AS 18 and in AS 24. So broadly, today we are going to discuss about related party transactions, disclosure requirements, everything under these 4 regulations alone. Okay. Now, the term related party is defined in these 4 places. We are going to first look at what is the definition of a related party under these 4 requirements. Okay. So to start with, who is a related party as per Companies Act? Like I mentioned earlier, Section 2, Clause 76 of the Companies Act, read with Rule 3 of the Company's Specification of Definition Details rules. It mentions who is a related party. Okay. So a related party can be a director or relative. We had related party, now we have relative. All sort of words with the same connotations come again and again. And it honestly becomes a little confusing beyond a point. But no worries, we can crack it down one by one. Okay. So first, director or a relative is considered as a relative party. So that is fine, quite simple to understand. KMP or his relative, a key managerial personnel or his relative is considered as a related party. So these are basically individuals who we are talking about, right? So what if the individual has another entity in which he is interested in? So next follows is that a firm where the director or the manager or his relative is a partner. Next would be a private company where the director, manager or relative is a director or a shareholder. Now, let us just try to understand for a minute why, all of these, people are included as part of a related party. Like my colleague in the previous session, he was mentioning control, significant influence. See, let us just take one step back before we proceed any further. Let us try to understand why do we have to, specifically look at related parties or related party transactions. Why do we need to disclose it? A company would be, having purchase transactions with hundreds or thousands of vendors. or they might be selling products to thousands of customers. But why do we have to look at related parties with a very special magnifying glass? What is the requirement? Can anyone probably just pick it up?
What sort of influence it has?
Okay, influence on what, ma'am?
On the financial aspect.
On the
You can
financial.
sell it at a lesser rate to that country.
Correct. So, it may have an effect on my profitability or my financial position, right? So that is one of the main reasons why we look at related parties with extra care and diligence. Now, why are these people included as part of related parties? Because they are said to have some power to influence the particular transaction. Very simple. We are all auditors. We all file income tax returns. We might be catering to hundreds of businessmen at the time of return filing. But in between all of those 100 businessmen, one of our family members will come. Can you please do this return alone for me? I am getting only a salary income of maybe some 15 lakhs. Please just do this one return for me in your time. And very honestly speaking, I'm sure all of you would be in the same position. You might not know what you can charge that person because he's a close family member. So they have these related parties or people who have whether they want to do it or not, they still have the power to influence the decision making, and they have the power to influence the transaction there itself. Whether it is the pricing or the terms at which the transaction should happen operationally, whatever it is, they have influence, right? So going back to the definition, director, KMP or his relative is considered as a relative party. A firm or a company, now by company first I mean a private company where the director or manager or his relative is a partner, shareholder or director. Now in the case of a public company, there is some more extra condition which is there. A public company where the director or the manager or the relative, okay, they hold either individually or together, more than 2% of the shareholding. In that case, it is considered as a related party. So let's say, for example, maybe we are talking about a director of say some XYZ private limited, and he along with his brother holds maybe 10 shares in Infosys. Does that mean that XYZ becomes a related party with Infosys? No, it will not be the case. Why this 2% limit? Again, it is considered good enough to have some influence over the transaction. Hence, the 2% criteria is involved for a public company. In the case of a private company, there is no such thing, because again, private companies are closely held. So, the moment you have some sort of a shareholding or a directorship, it is considered that you have enough power to influence the transactions in that company. The next is, we saw firm, private and public company. Next is any other form of body corporates, where you have a position in the board, and you are able to influence the decisions made by the board. So in which case you become a related party to such entity. And the other thing is, you might not be a director on the board, you might not be influencing the other entity's board to make a decision, but you might be a totally unrelated person to the director of the other entity, but you will still influence them in making the decisions in the board. There may be some cases. Okay. Now, the other criteria is a company which is the holding, subsidiary or associate of the relevant entity. They are related parties. Very simple, straightforward. Subsidiary is where I hold generally more than 51% or more of the share capital. If I hold it, it is a subsidiary. Associate, normally speaking, anything more than 20% but less than 50% is considered as an associate. Holding company is the company which is going to hold more than 50% of the share capital in my company. So these are related parties, quite fair and straightforward. Next one is subsidiary of the holding company, which is nothing but a fellow subsidiary. So they are also considered as related parties. Okay? And then we will be looking at this further in the further slides. An investing company or a venturer company. So who are these? We will just look at it in another maybe 2 or 3 minutes. Okay? And then the last one under the Companies Act definition is a director or a KMP of the holding company or his relative. Okay? Now this director does not include an independent director of the holding company. So there is a company, okay, and let's say A Limited, and it has a subsidiary B Limited. Okay? Now the director of A Limited is the holding company of B Limited, and the director of A Limited is considered as a related party of B Limited. Why? Because the directors of the holding company are expected to influence the operating decisions of the subsidiary as well. They are able, so that brings us to a very, very important point, which again we will discuss in the coming slides, that is called as control. I'm sure, even if you do not know, it is alright, we are going to discuss this anyhow. Under the Ind AS 24, Ind AS 110, under consolidation, you will have the definition of a control, wherein the standard will state that where the investee is able to direct or influence the returns, the variable returns of the investor is able to direct or he is able to influence the variable returns of the investee. The investor is said to have control over the investee. So control, the very crux of control is that you should be able to influence and get whatever you want from the other person. That is control. Right? So, very briefly, this is the definition covered under Companies Act, Section 2, Clause 76. Okay? Now, just a couple of examples.
Are chain subsidiaries covered here?
Sorry?
Chain subsidiary. A, B, C. B is a subsidiary of A and C is a subsidiary of E.
Okay.
Is C be a related party to E?
C would, so you are asking a multi-layered this thing. See, it is normally. For abundant caution, we normally consider it if you are asking it from an auditor's perspective, yes, we do consider that as a related party and we do all sort of testing as if it was a related party. But if you look at the definition of Companies Act, well, I don't see it to be a related party. From the definition of the Companies Act, it is not a related party.
So for approval purposes, I don't take the investment which is made in a chain subsidiary with the last level?
No, I think you will also have to look at the rules relating to the layers, management of layers also in that perspective. So that is a separate topic altogether, which probably we will have to look at a particular case and then we will have to take a call on that. Because you have other rules also in play, so that would have to be dealt with separately. Okay? So just a couple of quick case studies before we proceed. First one, X is a director of A Private Limited, which is a subsidiary of B Private Limited. So is X a related party of B Private Limited? X is a director of A Private Limited. A Private Limited is a subsidiary of B Private Limited. Is X a related party for B Private Limited? The answer is no. A is a subsidiary of B. Only the director of the holding company is a related party of the subsidiary, provided the director is not an independent director. Independent director by definition under 149 subsection 6 itself is that he is independent of the company's operations. So an independent director by all means is not considered as a related party. Okay. Next, Ashok is a one small disclaimer. All characters are fictional. No relevance to any movies or anything like that. Ashok is a director of 5-star Hotels Private Limited. He takes the advice of Annamalai to carry out the functions in the company. Is Annamalai a related party to the company or not?
Yes.
Why?
He can influence.
Exactly. So, functions of Ashok as a director of the company are based on Annamalai's advice, hence he is a related party. Are we clear till here? Because the next one I will try to confuse you, that is why.
But if it is a professional advice, then...
Yes, sir, that's the next question, sir. So, now next question is same thing. Yeah, please.
How do we check this in the perspective of audit?
How do we check this in the perspective of audit? So, see, today one of the happening consulting businesses is that, we give a strategy consulting or a CXO consulting. Okay, wherein the offices of a CFO or the CXO itself is outsourced to another management entity. So if that is the case, then it is normally considered as some services provided in a professional capacity. But as far as the question here is concerned, there is no hint that it is a professional capacity given. Professional advice is not given. Normally, I don't think in such a case there would be a documentation, very honestly speaking. But I think if we drill down into the transaction, then only we would know about it actually. If it is under the professional capacity, then you would definitely have a series of documents, agreements, NDAs, all that would be there. So it would be easier to identify which are the ones which are in professional capacity. Okay. So, next example is, like sir was mentioning, this Annamalai is providing the advice to Ashok under the professional capacity. So, he is basically a virtual CFO or CEO, whatever you can call it. Now, in this case, is Annamalai a related party? Is he a related party?
As a key manager person, you cannot provide.
No, the advice is given in professional capacity, hence he is not considered as a related party. In fact, there was one point which I had not given in the definition is that whatever we had covered this particular point that any person who is giving an advice or who is influencing the decision is a related party. But if it is given in a professional capacity, he is not considered as a related party. Okay, that is a proviso given in the definition of related party under the Companies Act.
So what is the difference between a KMP or under a professional?
Madam, KMP is someone who will be employed on the roles of the company.
Okay, this is someone.
This is someone who is outside the company. Okay?
So independent directors, they not be considered as related party.
No.
So the sitting CEO and the other remuneration related independent directors.
So, no, 1 second. Independent director, let me go back to that slide. See, independent director only for that last one, they are not considered as a related party. So, where we are saying that a director of a holding company is considered as a related party for the subsidiary, there alone we will exclude independent directors. But in general, any director is considered as a related party, and the sitting fees paid to an independent director is disclosed under the RPT disclosure in the financial statements. Okay? Can I proceed? Or if there are any more questions at this stage, I would be happy to take them. Yeah?
So who's the relative, you said like directors or relatives, right?
Yeah, so that is the next slide. Yeah. So who is a relative? Now, section 2 clause 76 covers a related party, 2 clause 77 covers who is a relative. Relative with respect to a person, any person is related to another if they are members of a HF. So if they are the member of the same HUF, then you are considered to be a relative. If you are husband and wife, you are considered to be relative. Father, mother, son, including stepfather, stepmother, stepson, you are considered a relative. If you are the son's wife, it is considered to be a relative. Daughter, daughter's husband. Brother, sister, including stepbrother and stepsister. I don't know if this was intentional or not, but when I was preparing for this, now only I had realized that everywhere we are able to see stepfather, stepmother, stepson, but for daughter alone, we have not seen stepdaughter. I don't know if it was intentional or not, but I still don't have the answer for that. I'm still looking for it. But yeah, somehow it is not there in the rules.
So is it because the hierarchy is not there?
Probably, not sure. So yeah, it's a little funny, but yeah, okay. Considering the progressive society we are living in, it's a little tricky. Okay, so these are the people who are considered as relatives under the Companies Act. Whatever we are seeing is only the definitions under Companies Act. Okay. Now, one more point which we have to cover under the definition of a Companies Act is that we had seen one particular related party who is known as the investing company or venturer of a company. Who is that person? So, investing company or the venturer of a company means a body corporate whose investment in the company would result in the company becoming an associate of the body corporate. So, it is much easier if we just look at it from with two examples. So, company A holds 30% share in company B, right? Now, because of this 30% stake in company B, A does not become a holding company. But maybe it is possible that it can have some significant influence, unless proven otherwise. Okay, the general presumption going by that, A has some significant influence over B's financial and operating policy decisions. Here, A is considered as an investing company of B, and hence they are related parties. Okay. The next example is, there are two companies, C and D. They both come together and form a joint venture. Let's say they form company E. Now, C and D each hold 50% stake in company E, which means they have joint control over company E's operations. All the decision making, they have 50% stake in each. So this is not a joint venture, it is more of a joint control over company E. So here, C and D are called venturers of company E. Obviously, they are related parties for E. The question here is, are transactions between C and D considered to be related party transactions? Yes. Because they have a common connecting point called as company E. Hence, it is possible that the transactions between C and D can be influenced, and hence they are considered to be related parties, and they require special care and diligence from a reporting and audit perspective. Yes, sir.
If that company E is a partnership firm, the joint venture constitution is a partnership firm, and C and D have invested money in it, equal or whatever, even then the same rule of law.
Yes, sir. Still. So, the concept of joint control does not mean it will be only in case of a company, it can also be in the case of an LLP. I mean, currently the laws relating to partnership firm does not allow companies to become partners, but LLP you can definitely form between two companies, and in that case also it is still considered as a joint control, even under the accounting standards. So in that case, what happens is, they will still be considered as related parties.
In the partnership firm, those two companies can be partners, right? As a body corporate, a partnership firm can have companies as partners.
I don't think partnership firm you can have companies as partners. LLP you can have, sir. Yeah. The Partnership Act, I think, specifically requires individuals to be partners. So I don't think you can have a company. I'm not a great expert about it, but I'm quite sure an LLP can be found with two body corporates.
And in your earlier example 1.
Yeah.
Even instead of 30%, adding 20% also. Section 2, subsection 6 makes it an associate company because of substantial lending. Automatically it comes under related party.
It does make it it makes it a associate company, sir. The question is, what if it is not an associate? So see, we again, if you look at the definition of an associate, you need to have significant influence. Okay. And what is significant influence? If you have influence to, if you have the power to influence the financial or operating policy decisions of a company or an entity, it is considered to be an associate. Okay. Now, there may be cases where it cannot completely, influence the decisions of the other entity. Whereas it may have a very good investment, it may have a very good stake like this one itself. It has roughly about a 30% stake in the other entity. Okay. So in that case, they even if you do not term it as an associate, quoting the significant influence criteria, you are still termed as a related party in terms of Companies Act, being an investment company, investing company. That they actually the objective is that they would want to cover as much of entities as possible within this bracket, so that we do not have transactions which evade the relevant provisions pertaining to related parties.
So does it mean that even if I have a 20% stake and I don't have a significant influence, it would not come under the ambit of associate, is it?
Yes, sir. You can. So even if you have 60% stake in a company, you can still not call it a subsidiary, sir.
A subsidiary is okay. Oh.
The same thing applies for this also.
Associate also.
Yeah.
I have a 20 or 30% stake, but I don't have a significant influence.
Yes.
Which should be probably brought in by way of a document or something. Right?
Yes, probably something like, something to show your, like how my colleague Manish had mentioned earlier, something like a SPA or a SHA, or maybe some sort of a document which clearly states that you don't have a voice in the board, something like that. Like very simple, like all these captive power generating companies.
That is what I was trying to refer. They have 26% share.
Yeah, they have it only because of the electricity regulations.
PNERC regulations.
Yeah. So only if you have 25% or more of paid up capital in that entity, you can call it as a captive power consumption and you can claim the rebate in your EB bill. So in that case, those entities do not have absolutely any right in the company. They don't have representation, they don't have dividends, nothing they have. It is very clear in the shareholder agreement itself.
So section 129 subsection 3 also may not be applicable regarding CFS, consolidated financial statements, otherwise it is applicable for an associate company.
Yes. Yes.
Thank you.
Okay. So that pulls the curtains on definition as per Companies Act. Next is the definition as per AS 18. AS 18 talks about related party disclosures. Now, just to give you one more small hint, AS 18 and Ind AS 24, both these standards are only strictly disclosure standards. They do not talk about accounting, recognition, measurement, nothing. The only purpose of these standards is to give us guidance on identifying related parties and disclosing the transactions with those related parties in the financial statements. Okay, so no sort of measurement or recognition principles are given in these two standards. Okay, now under AS 18, who are related parties? These are some of the guiding parties which have been given. The definition I will give it to you in the next slide. Actual definition in the standard I will give it in the next slide. But before going to that, let us first list out who are all the related parties as per the standard. enterprises that directly or indirectly through one or more intermediaries control or are controlled by or are under common control with the reporting enterprise. Basically a subsidiary, holding or associate company. They are considered to be a related party. To put it very simple. Okay. Again, here if you see in AS 18, the emphasis is on control. Okay. Next, associates and joint ventures of the reporting entity and the investing party or venturer in respect of which the reporting enterprise is an associate or joint venture. So basically the company in which we are investing, the two, so in our previous example, C and D are the venturers, E is the joint venture, so they all become related parties. Okay. The next is individuals owning directly or indirectly. So see, the usage of the words directly or indirectly pretty much means relatives, existence of relatives or siblings and things like that. Okay. So individuals owning directly or indirectly an interest in the voting power of the reporting enterprise that gives them control or significant influence over the other enterprise and the relatives of such individuals. Okay. So pretty much more or less whatever we had already seen in the Companies Act definitions are only coming in over here. Yes, sir.
Here, the voting power normally means voting power by as a shareholder.
Yes, sir. Voting power normally means voting power by the shareholder.
Can it also extend to the voting power as a board member? Voting power as a shareholder is not there, significant. But voting power as a board member is there. Then what happens?
Voting power as a board member. So that means, see.
In the previous lecture which I spoke, same example.
Yeah, you had asked 3 board members are there and one of the directors are influencing. That is the same question you are referring to? Okay. So, sir, now voting power, like you said, need not necessarily mean only in your AGM or EGM.
Definition of the Companies Act it says only AGM.
Yeah. In Companies Act it says like that. But see, from a AS 18 perspective, again it talks about control or influence. And by the very definition of your control or influence, if you are having the right to control the returns or if you are able to influence the policy decisions of the other enterprise, now how can you influence? It is not necessary that you can influence all this by being a shareholder. More, you can influence it only by being a board member. Now, if say for example, let's go back to SIRC's example where he said there is a company which holds say 26% of the share capital in another entity, calling it a captive power consumption unit. So see, they don't have any representation in the board. Now, if they were to have say out of 6 board members, 3 board members are that company's directors, then you can say they have the power to control the entire investment, the returns and the decision making of the company. In which case, they would be considered as a subsidiary or associate, whatever it might be, and accordingly the consolidation might occur for them. Okay?
The combination of that, can you make it an investing company? Definition of investing company. 276.
Yeah.
The 276 says got a provision that associate in the capacity as an investing company is called investing company. Right?
Right.
So, in a combination of a shareholding in a as a private limited company, another private company, and a directorship of a common director having 1/3 veto power, will it make it as an investing company and definition 276?
No, sir, investing company normally does not have much of a power to,
The definition of relative party, 276 has got 2 roles. One is associate, another is called investing company also.
Correct. Okay.
It's H or something. If I'm not
yeah, okay.
So associate in an investing role is called investing company. Okay.
So
associate in investing company role, can it be through a board?
Sir, when you are saying it is an associate, it already has a...
Associate doesn't have 20%. Okay. And I'm assuming the associate independently controls only 9% of the shareholding.
So be it. Okay.
Now, 9% of shareholding is there, but the common director is having 1/3 voting power in the board.
Okay.
So I am defining as the auditor that 1/3 voting power in combination with 9% of the investment. I am making that company, which is investing company here, also associate, and since it is associated in the capacity of investing company, 274H defines as an investing company.
Okay.
Is this logic right or wrong? Because this is debated at a very high level, and we are trying to put it very to ICI on this.
Okay. So,
There is influence.
I would rather say that it would be categorized more as an associate instead of an investing company.
No, associated investing capacity is called investing company only, as far as definition of 236 is concerned.
Associate in investing company. Associate means that the company has invested in that company. Okay. Here is reverse flip. My company, which is for whom I am defining the KRP, has got an investment from that company. Okay. So that goes under 276H. Doesn't go under associate. Associate in a role of investing is called investing company as per definition of the Companies Act.
Is the director posted as a nominee of this?
No. That's it.
Significant influence.
No, but
there is no 20%.
I agree. There is no contractual influence, but there is an actual influence by your participation in the board.
So, sir, 1 second. Sorry. Maybe what we can do is, if I can get some more clarity, but let us just finish something here. And in the break time, maybe we can just take this offline, discuss it, and maybe when we are resuming the session, we can bring it out for the wider audience. Okay? So, yeah. Okay. So, going back to what AS18 defines as related parties, we saw enterprises, basically subsidiaries, holding companies, associates, joint ventures, individuals who control or exert significant influence over the enterprise. They are related parties. Okay. KMP and relatives. So I have underlined the word relative. You will definitely get why I have underlined relative in some time. Okay. KMP and their relatives are considered as related parties. Enterprises over which any person who is described above is said to exercise significant influence is considered as a related party. Okay. Now, yeah.
In the previous the individuals owning directly or indirectly.
Yeah.
You were mentioning directly or indirectly itself means that the relatives of the
relatives. Other than indirect could also mean where you are having a beneficial interest or ownership, which influences the transaction or the rights over the decisions of the enterprise.
Will that word itself not include everything? Why that again and relatives of such individuals?
Just making it abundantly clear. That's it. See, some things. What happens is in all our standards or laws or regulations, over the years, what happens is that they tend to go over the cautious and they tend to give as much as detail as possible to avoid any sort of mischief. Now, in our rules of interpretation in law, we have something called as a Hayden's rule. Or it is also otherwise there is another rule called as mischief rule. So what is the mischief that the law intended to plug? That is something which always regulators or lawmakers keep in mind while they are plotting all of these words. So it is just out of pure abundant caution. Okay. So these are considered to be the related parties under the definition of AS18, more or less similar to whatever we have already seen in Companies Act definition. Nothing majorly different. Okay. Again, relative, we have a meaning which is given in the standard. Relative is spouse, son, daughter, brother, sister, father, mother. These people are considered to be relatives.
Yeah, no steps.
No, that I don't think it has been given in the standard like that. But I mean, we are safe to assume it, considering the fact that it is given in the Companies Act. So, and these, why are they considered as relatives, or ultimately they are considered as related parties, is because they are expected to have some influence, or they are expected to be influenced by. It can be both ways. You can have a purchase and sale, right? So, in whatever dealings are being made with these persons, it is expected that there can be some influence. Okay? Now, just a couple of more questions before our lunch break. Company D holds 40% of Company E, and Company F holds 60% in Company E. Despite having a minority interest, Company D controls the management of Company E through a contractual agreement. Sir, your question somewhere remotely comes here. Okay? Through a contractual agreement, even though having minority interest, they control Company E, allowing it to appoint the majority of the board members. Should Company E be considered as a related party of Company D or of Company F? Any inputs? No, yes, okay, but which company should be considered as related party?
D will be.
Okay.
Both D and F. Both.
Why F, sir?
Oh, F holds 60% rate.
Okay.
60%
Okay.
So, it may come under the category of, holding, holding company.
But there is a contractual agreement which clearly states that D only controls the company. There is no,
Yeah, but see, for some transactions we need shareholders approval also, right? So in that case, F may also control. Like,
F may also control.
60% of voting rights means anything above 51%.
Yeah.
Obviously, whether or not there is a contractual agreement, they have an obvious control. Unless it is a DVR, differential voting right or something like that.
Sir, normally what you are saying will work, but if there is any specific agreement to the contrary that these entities, because we have seen certain exceptional cases where there is a company which holds almost 80% of the shareholding or 90% of the shareholding in another entity, but they are not considered as the holding company and they are not consolidated. Okay. Why? Because the minority interest will hold all sort of influence, control, everything over the company to the extent that they will run the show. These guys have merely given investment. Now when I think about it, although I have given the answer that because it is under D's control, D will be considered as a related party. See, but technically speaking, the other entity will also be considered as a related party going by the definition of this investing company. Going by that, ideally I think even the other entity should also be considered as a related party. Only thing is that from a consolidation perspective, this might change our answer, that's all. But ideally both are related parties.
In the example you are saying that 80%, 90% not considered as a related party, I think.
No, it is considered as a related party. It is not considered for the purpose of consolidation.
Even that, where balance is excluded, you need to do that.
No, thing is that again, going by the definition in the standard, you need to have control to exercise and by control it means that you have the right to influence and extract the returns from the company at your will.
But that will not override the act, isn't it? From giving subsection is clear about what is going to be the C of this. So can the standard override the act?
So, sir, now there are two things here. Consolidation you may still have to do only for the limited purpose of Companies Act with respect to certain requirements under Schedule 3 or Section 129. Okay. Then going by your instance, in that electricity company that you are mentioning, they should also consolidate from an associate perspective, no? Their equity method.
Schedule 3 with this AS 18, I think there is one exception to that. Of course, we are entering into a shareholders agreement where
exactly.
we say that absolutely no discretionary control.
Exactly. So that is the same thing here.
Much less than 60%, 26%.
So,
but much less than that.
Agreed, sir. But still, it is only a question of whether it is a subsidiary or an associate. Either ways, you can still have an agreement in place like this. If one entity does not consolidate, the other one is going to consolidate. Standard also does not say that no entity will consolidate. One of you should consolidate. You decide who has to consolidate. That is what the standard is saying. And how you should decide that is based on whether you have control over that entity or not. Okay. Now, the answer on your screen is incorrect, in my opinion. Both entities are to be considered as related parties. One will be considered as maybe a holding company. The other one might be considered as an investing company. Hence, both are considered to be related parties.
But this example is for the private limited company. In case of public limited company, 2% holding is already there. No? That clause is already there. Related party. The companies.
That is directors holding, not the company itself. Okay.
So for the purpose of consolidation, if there is 90% shareholding, if there is no control, you need to say that the consolidation is not required.
Not required. But only thing is you need evidence. I have seen, in my own case, we have seen a company where they were mentioning that they don't have any control over the other entity, but they could not come up with any, they don't have an agreement to that effect, they are not able to present any board minutes which give that indication. We have to modify our opinion with respect to the fact that consolidated financials are not prepared for this company. So there are instances. The only thing is you need to, as an auditor, we need to have sufficient evidence indicating the fact that control does not exist, because that is a very critical requirement of the standard as well as the Act. See, even in the Companies Act, if you see, subsidiary, the definition of subsidiary is that the company is able to exercise control over that company. And by control, it means that you have some right over the variable returns of the other enterprise. So if that is not there, then ideally you don't have to consolidate.
So when some decision for shareholders accord is coming up and this 90% shareholder, they have an influence, right?
No, but again, it is all going to be, are they going to be the most critical thing that stops the company from its operations? That's the only question.
We upload to the shareholder when it goes to the shareholders. Because 90% shareholder has got an influence and control.
Madam, in those cases, I'll be honest with you, we'll have to look at again one case at a time. Wherever these exceptional things happen, we'll have to look very deep into it. Okay, but it may always be possible that these shareholders are basically holding the shares so that they can, at one fine day, they can just sell it off for a very good price. Okay, it can always be like that. You don't know. Now we are talking, your question is basically from the perspective of consolidation, correct? So maybe we can take it offline and we can discuss on the, if you have certain particular facts, maybe we can discuss on that separately. Okay. Next example is K serves as the CEO of Company G and is also on the board of Company H, an entirely unrelated party. Okay, K is the CEO of G and he is also on the board of Company H. Company H and G engage in some transaction which is at arm's length. Are Company G and H considered to be related parties?
Yes. Yes,
You can't simply tell that they are related parties. We also need to see what is Mr. K's influence on company H. If he is merely a independent director who has been appointed to serve company H's compliance under the Companies Act, then we don't know to what extent he might have influence over directing the policy decisions of the company. Okay, so they just because there is a dual role does not automatically make it a related party. He is a KMP in company G.
Their reporting is mandatory as KMP.
Reporting as KMP will be mandatory. But whether the transaction between G and H is considered to be a related party or not, we can't decide based on this much of facts. We will need some more details as to what is his influence over company H also. Okay?
It depends on the contractual obligations.
Yes, exactly. Correct.
That is a significant factor.
Yes. What is
the role that you are playing?
Correct. What is the control or what is the influence that you exercise over an entity? That is important to determine whether you are a related party or not. Okay. Next question is a director of company A has a brother who owns significant shareholding of a key vendor called company B. Director has no financial interest in company B, but both companies transact frequently. Are they considered related parties? Shareholding is an indicator of influence or control, but again, it is difficult to say with this much of information. We need to know whether he is able to actually direct.
No, you're mentioning is a significant vendor.
Significant shareholding he has. Relative of a director has a significant shareholding in another company. That's all. Nothing more than that is given. Now whether he is the one who is running the show, if that is the case, then they are related parties obviously. So now you may, after all this much of drama, you will ask me, boss, all you are saying is theoretical, what do I do in practice? I am the one who is preparing the financial statements, I have to do the audit, I have to sign, I have to take the hit or fall, whatever you might call it, disclose everything. If your client or if you are as a management person, if you are able to substantiate the fact that the control is not there or the influence is not there, if that is there and it is apparent, evident using some documentation, then we can definitely, with some level of confidence, we can say that okay, they are not related parties and we can move on without a disclosure.
Now between Companies Act and this AS 18, what is the significant thing that is different between the two? Because everywhere it's the same.
Nothing major. No, unless it's the same thing.
So it's the same like relative,
yes,
person
yes.
plus the significant control and
Yeah,
influence.
yeah.
All this matters in both.
Yeah.
Sir, he may be an ordinary director, but when you say the significant shareholder, key vendor, any human system is always weak. He wants to make more profit for his company, show more dividends, more prospect for the bankers.
Natural, sir. Correct. So, correct. That's why I said in all practical aspects, you just take it. Unless there is any proper documentation to the contrary available and presented to us.
It goes case by case.
Yes, sir.
Disclosure is whether it's a mutual requirement. If I disclose one party as a related party, whether that party also has to disclose myself as a related party in their financial.
Sir, are you the auditor for both the parties?
No, independent auditor.
Okay. So, see.
They may take different views.
So, that is something that you may not be able to exert influence on that. But see, this becomes a very important thing when you are having a group of companies. Let's say, for example, in a group you have about 10 to 15 entities. And you know, what happens is your question becomes of prime importance for the auditor who is handling the consolidation. one entity will show sale here, the other entity may not show the purchase there. It opens up a Pandora's box for the auditor who's consolidating, and he will be on a wild goose chase, chasing every auditor, asking them why this is not there, should you correct it, will you correct it, all that will happen. So what happens is, in those cases, normally companies have some sort of a system wherein they align their transactions. Big groups normally align their transactions using consolidation tools like HFM or Hyperion and things like that. So in those instances, you will normally not have such issues. But otherwise, yes, see, it may not be, it may be a situation where you might disclose it as a related party transaction, but the other may not do it as well. We may not know what are the reasons why they are not disclosing. They may have their own reasons to do it. Okay?
From the reporting point of view,
yes, sir.
As an auditor, am I supposed to look into whether the transactions are being authorized by the board and end with it, or should I get into the arm's length price examination and then all such things?
So, see, that is something which is covered under SA 550. Okay. Now, normally what happens is, the standard says that we must also go to some extent to assess whether the transactions are at arm's length, because see, our reporting requirements also require that we need to disclose that they are at arm's length. One way or the other, either in your RPT disclosure or in your board's report, you will have to disclose that they are at arm's length. Very simple, sir. In your management representation letter, under the heading of related parties, the management will provide a written representation that the related party transactions have been sufficiently disclosed pursuant to appropriate approvals, and they are at arm's length. That is what they will disclose. That assertion, how as an auditor we will be able to validate? Only if we get into, at least on a sample basis, if we can get into the arm's length testing, then only we will be able to validate that assertion. So what we normally do is, in such cases, there may be some sort of, if there are some cross-border transactions, normally clients should have a transfer pricing report or a compilation available, because that would serve as their document for the income tax as well. So, sorry?
Domestic transactions which fall under the related party transactions.
The other parties, how we are charging, that is what will be the...
Yeah, so normally that is how you will have to do it. I mean, what are we charging to one entity, how are we charging to the others? So that can happen only in an apple-to-apple comparison. What if, the services you render to a related party is different from an unrelated party? So that again basically, goes into several aspects. How do you do an arm's length testing? So ideally, yes, we as an auditor, we should get into that as well.
The transfer pricing policy again, if you can answer.
Sorry?
The transfer pricing policy of the entity.
Hmm.
That has to answer.
If it is there, then yes, that has to answer. If it is not there, then we'll have to see what else we need to do. Okay? So one last thing before we break, just a couple of more points under the AS 18. This is the actual definition of a related party under the AS 18. The first 3-4 lines that you see there. Standard states that parties are considered to be related if at any time in the reporting period, one party has the ability to control the other party or exercise significant influence over the other party in making financial or operating decisions. What is control? Ownership, directly or indirectly, of more than 1/2 of the voting power of an enterprise, or control of the composition of the board of directors, or having a substantial interest in the voting power and the power to direct the financial or operating decisions of an enterprise, either by statute or agreement. So it includes contractual agreements also. Significant influences participation in the financial or operating policy decisions of an enterprise, but not control of these policies. So you do not have control over it, but you have the right to, you have the say to, probably influence the decision making while arriving at those policies. Let's say there is a key financial decision which is happening in the organization. If you are having a significant influence, you will have the right to have your voice would be considered with a priority if you have something to say on that particular financial policy decision. Okay? Yes, sir.
For a particular financial year, after 31st March, some due to natural causes, the CFO or the MD goes up. Okay? Should we report the after balance sheet event, or how do we report it? Suppose he says March, after results only they will be knowing.
So March 24 was your reporting year. Okay. Somewhere in April, maybe the MD has passed away. Okay.
So this man we are trying to influence, increase the dividend or whatever, if some proposal comes, should we report that?
Yeah, anyways, yeah.
So who tries to influence us? Sorry?
Oh, the new man.
The new person.
Yeah.
Okay.
The profitability, during audit, something happens, he says don't show this, don't do that.
Okay, okay. Understood, sir. Understood. So what we do is see, because our balance sheet date is 31st March 24 and this person was not there at that time, okay, this new person. What we do is, in our related party disclosures, we normally mention even that person as a related party, giving the dates from which, they are listening, okay, and we consider him as a related party.
Especially the decision made by the new person.
Yes, yes, yes. Because, see, if you are talking about an MD or another director, normally they would also be signatories to the financial statements.
That's what I'm doing.
So, yes, you will have to consider them as in disclosing them.
Putting the dates.
Yes, yes. We'll have to give, like, whoever is the past person until so and so date, and the new person will be with effect from so and so date. That is how we'll have to do.
It happens in the public companies, government companies, how do you do all these things? Because the CNDG is very tough about all the standards. You know about public company, Wilson Francis of the government, they keep on changing it.
Yes.
Every 3 months they put new MD, new.
Yeah, correct.
The same chairman, MD gives loan to the other entity, same government. They say, sir, our government will not charge interest. I had a particular case. So we recovered for almost 7 years interest for 8 crores. So in those cases, what shall we do? Because that man, the A company will be there, B, suddenly then he is transferred back again. Those cases, should we give a narration or what?
It is better that we give a distinction. For our own sake, I think it is better that we give a distinction. Because it is, like you said, handling public sector undertakings is a very tricky scenario.
Careful in seeing appointments.
Yeah.
Every night. Because you keep on changing according to
and your distinct post-audit question answers are also quite tough and tricky to handle as well. So, I think for abundant caution, it is always better that we disclose all that in the financials.
Thanks.
Any other questions before we break? Okay. So once we're after we come back from the break, we'll just continue on who is a related party as per the Ind AS 24 and as per the LODR regulations, and then we'll move into related party transactions and their disclosures. Okay. Thank you. So sorry for the delay. So going back to our discussion on related parties. So now we had seen Companies Act definition, then AS 18 definition. Now we will go into Ind AS 24. Now who is a related party as per Ind AS 24? So a related party with respect to the reporting entity is, there are 2 major headings and then you have several sub-items available in the definition. Okay. So a person or a close member of that person's family. Remember in AS 18 or in Companies Act you saw the word relative. Here the term is close member of that person's family. Is related to a reporting entity if that person has control or joint control of that reporting entity. Control or joint control of that reporting entity, has significant influence over the reporting entity, or is a member or of the KMP of the reporting entity, or of the parent of the reporting entity. Basically, again, whatever we saw in Companies Act, same thing comes here. If you are the subsidiary, associate, joint venture, or if you are a KMP, or you have a director, if you are a director in the holding company, same things that we saw in Companies Act definition comes here. Okay. Then an entity is related to the reporting entity if any of the following conditions is satisfied. So what are they? So now basically the standard is giving what are the indicators of a related party. So the entity and the reporting entity are members of the same group. Okay. Which means that each parent, subsidiary, fellow subsidiary, everyone is related. Okay. There was someone who had asked layers. Okay, she's not here. Okay. So basically now under Ind AS it gives a slight indication that maybe that also has to be reported as a related party. In AS it was not this clear. So now what do we do if it is a AS company? AS applicable company means abundant caution, we will disclose it as a related party. This is a normal practice that we take in all practical situations. One entity is an associate or joint venture of the other entity. Okay? Both entities are joint ventures of the same party. Whatever we are seeing now are the same things that we have already seen in Companies Act or AS 18. Investment company, venturer of a company. The venturers are also related parties. Same thing is what we are seeing here. One entity is a joint venture of the third entity, and the other entity is an associate of the third entity. Okay, so there are two companies which form a joint venture, and there is another entity which is an associate. So then again these all become related parties under the definition of Ind AS 24. Now Ind AS goes, see finally what is the difference between AS and Ind AS? Both are international standards. Only thing is AS was the international standard some few decades back, and when IFRS had when there was a call to revamp our local accounting standards to make it at par with the international standards, we termed it as Ind AS or IFRS converged accounting standards. Right? So whatever we have seen in AS will still continue to apply in Ind AS except for a few differences. One such difference is Ind AS also considers a situation where we have an entity in the group which acts as a employee benefit entity which is there only for the employee benefits. Like for example, there may be a group which has a let's say for example 10 entities are there in the group. One entity amongst those 10 would be acting as a gratuity trust. So in which case they will see what happens is all the other entities may not be holding anything in that trust, but still it is considered as a related party because for all the employees of the entire group, this gratuity trust will act as the as the entity which is going to provide the employee benefits. So hence that is also considered as a related party. Okay. Apart from this difference, the other major difference between AS and Ind AS is that there are some exemptions available for government entities. Okay. Keeping this in mind, yeah, tell me.
As far as associate and holding company is concerned.
Okay.
In AS 18 and all, we were talking about control and influence. But here that's not mentioned. So the criteria will be that 20%, 51%, that is all.
No, nothing like that. So see, for that again we'll have to read it in in continuance with other standards also. Okay, so again the same logic applies even here. Okay, if you read it in context with other standards, then the same logic will continue to apply. Okay.
Sir, hello.
Yes, sir.
For Section 25 companies,
there
are many companies are doing a lot of public
right, sir.
clubs are also connected.
Yeah.
They have got a separate welfare trust
to
help them for employees scholarship and employees education and medical benefits and all. So normally the same committee members, secretary or president will man the trust or that fund. So they are declaring, but also we have to declare, disclose or what? This company's balance sheet.
So, sir, in that section, so you have a, if I can understand your facts correctly, you have a Section 8 company or Section 25 company. Yes. It has created another company or an entity which manages the gratuity or some employee obligation, benefit obligation of the employees of this particular Section 25 company, correct?
Not obligation exactly, some funds to help the welfare of the employees.
Fine, whatever, okay. Basically for employee benefit. Okay, fine.
Not obligation, benefit.
Okay. So even in that case, this Section 25 company only would have incorporated that entity?
Yes, definitely.
So in that case, it becomes a related party because the sole purpose of that entity is only to cater to the employee benefits of this particular company.
They run a canteen also for that. They have got some 300 employees. They have got a canteen also to give them food all the 3 times, night duty or day duty. And the children for the marriage they give some donation. The medical expense also they give. So like
okay, so
employee benefits.
Okay, it is for current ongoing employee benefits, not any post-employment benefits. Okay. So, okay, fine. So, sir, understand, going by whatever the facts I am able to see from here, I think you will still have to consider it as a related party. The only thing is you don't have to look at it from the perspective of an entity which is giving post-employment benefits to your company. But, considering the fact that, it has significant, and you're saying the same committee members are also again there in that entity in significant. So in that case, then you will have to consider it as a related party, sir, because there is control and influence available in that, so it will be considered. Okay. Yeah. So then the entity is controlled.
That is not. They are not deriving any profit out of it. Only the benefits. That's what my question.
No. So
employees are benefited for the welfare of the club, welfare of the institution like that.
So now, if you look at it,
any salary, I agree. There is only one way. No, not this way. They don't contribute anything.
So what happens is that, see, we also have to look at it not just from the fact that there are actual returns. Okay. Now, in terms of returns, if you see, example, you were saying that they are running canteens for the organization and all that. So what happens is then to that extent your cost of this thing is also cut down, right, for your organization, and also to the extent that the same key members direct or influence the decision to run that organization as well, which in turn benefits the ongoing organization. So however you look at it, even if you don't have a
tangible or intangible,
even if there is no quid pro quo, if you can put it like that, you will still have to consider it as a related party. So entity is controlled or jointly controlled by a person who we are referring to in A. That is,
sorry.
Yes, sir.
Related party transaction, transfer pricing, all the fundamental is the financial aspect. Not to make undue profit, okay? Not to derive any influence, not to reduce the cost for the company like that. This employee benefit also will come. It's not any commerce or any other trade transaction.
Okay.
The welfare are purely like the ESI, PF, and some welfare fund. It is created. In spite of it, you have to show the related party. That's what.
It would ideally come, sir.
Okay.
See, what happens here is that even though there might not be as such, in furtherance of a business, if we can call it like that, even if that is not there, okay, even if you don't have the idea of making a profit through this entity, okay, this entity which is, benefiting the employees of another organization, even if that profit element or motive is not there, what happens is that the transactions would ultimately impact, the objective of the related party transaction disclosure itself is that if you have an interested entity available, okay, what happens is that, you will have to definitely disclose it and look at it with more care, because it poses a likely effect on your profitability.
If it's good for a commercial company, I do appreciate making profits, declaring huge. It's by nature itself, is a non-profit activity. The club is a non-profit activity.
Understood, sir. Understood. But still, what happens is it affects your financial position and also your cash flow.
Okay.
We might not be looking at it from a profit perspective.
It's the basics.
Okay.
Thank you.
A person identified in A1. So a person or a close member of the person's family who has joint control or control of the reporting entity. So a person like that, if he has significant influence over another entity or is a member of or a KMP of that other entity, then they are related parties. See, when you look at all these points, it again and again goes back to whatever we have already seen in AS 18 or Companies Act. Okay, there are not much differences. The only additional thing that we would have probably seen here is that post-employment benefit trusts or organizations which are available in a group. Okay.
Another additional thing would be,
yes, sir.
AS18 probably does not warrant you to give the list of related parties, whether or not you want a transaction. I think here you will have to give that, whether or not you.
We'll come to that, sir. We'll come to that. Okay. Last one item is, I think someone in our audience had asked this, anything given in professional capacity as a management entity. So, entity or any member of a group of which it is a part provides KMP services to the reporting entity or to the parent of the reporting entity. Now, we said there are companies which offer CXOs, consulting services. Okay. They are outside the group. In large MNCs or in some large group of entities as well, you might have one organization which basically gives the entire CXO services to all the entities in the group. Now, there might not be a shareholding of any of the other entities in that particular company. Still, they are considered to be related parties because the cost of that KMP will be allocated to you. Otherwise, there is no point in having a separate entity which offers CXO services to all the entities in a group. That is the very essence why we have a management fee allocation or a critical cost allocation across MNCs and other group entities. Okay. So in that sense, these will also be covered under the ambit of Ind AS 24 as a related party. Okay. Now, we saw who was a relative as per Companies Act. We saw who is a relative as per AS 18. Here the terminology which we saw was close member of that person's family. Who is that person? Close member of the family are those family members who may be expected to influence or be influenced by that person in their dealings with the reporting entity. So, at first, they are not saying this person is a close member. They are not defining like that. They are saying anyone who can be influenced or who will influence your dealings. That's it, very simple. So who all are included in this? So there is an inclusive definition. Okay, children, spouse, brother, sister, father, mother, children of the spouse. Basically stepson, stepdaughter type. Dependents of that person or that person's spouse. These people are included in the definition of a close member. Okay?
Domestic partner, how do you establish? How do you authenticate? How do you legally?
Very honestly, I'll be very honest with you, sir. I don't know. I don't have any difficulty in admitting it. I do not know how do we.
Very dangerous class.
It is there in the standard as a spouse or domestic partner, but very honestly, I do not know how do we classify as a domestic partner.
That might have been suffering from.
Thankfully, I have not. I hope I have not seen any cases so far in my experience. So, if I do, I will definitely notify you. Okay. Just a couple of case studies. Company A owns 40% of Company B. Company C owns 35% of Company A and B. A owns in B. C owns in both A and B. Despite no single company holding a majority stake, 3 companies have common board members who make strategic decisions together. Are they related parties? How many of you say yes? Show of hands. No? Okay. So they can be considered as, based on whatever is available here, yes, they can be considered as related parties.
Cross-holding.
More than the cross-holding, their common directors are influencing the decisions of all the companies, so they are considered as related parties. A director of company F has a spouse who owns a significant share in company G, a major supplier to company F. Director has no financial interest in company G and does not participate in the management also. Are F and G related parties? Spouse is holding significant shareholding in the other company which is a major supplier. Are the 2 companies related parties?
Yes.
Yes? Let us see. So again, same thing here, goes back to whatever we have been discussing. The influence. If by the major shareholding, if we are going to be able to influence or direct the decisions of the company, then probably we could say that it is a related party. And if it is a mere shareholding and there is nothing to see on the face of it, as auditors we will definitely say they are related parties, no doubt in that. Unless you have something to the contrary to state, some sort of a contractual agreement or something which states that, well, just because I have the shares, I am not having anything to do with this company. If you have something to say that, then, well, okay, you can say that these are not related parties, but otherwise, yes, as auditors, we will definitely say that these are related parties. Now, going to the SEBI listing regulations. All parties covered under company. See, this is a very beautiful definition. I like it very much. Very simple, short.
Exhaustive.
Very exhaustive. All parties covered under Companies Act. All parties covered under accounting standard or Ind AS. They will not stop with that. We have some deemed related parties. Now, who are these deemed related parties? Any person or entity forming part of the promoter or promoter group of the listed entity. Basically, the promoter group is also considered to be a related party. Okay, madam, it might be obvious to you, but for abundant caution, they are making it very clear. Why? Because more so, SEBI will be even more careful with their wordings because public interest is at stake.
What is forming part of promoters?
Sorry?
What is forming part of promoter? Promoter group is fine. What is part of promoter?
So, promoter need not be just individual. No?
There's some big companies, you know the example now, live examples. The main promoter just goes off some time. Even the former promoter is also counted. Holding shares, but he has come out. He will be counted.
After this lock-in period, you would have come out. That is what you're saying.
Even after long period, he has developed the company. For instance, Infosys is like that.
No, sir. See, what happens is we normally declare who is a promoter in all our filings and all that. So, when we are declaring, if that person has been declared as the promoter, then we take that person to be the promoter at every instance that we are looking at it. So, let's say, for example, a company is now getting listed on the stock exchange. Okay, we would declare certain persons, individuals, or other entities to be promoter or promoter group. Okay, now as per the ICDR regulations, they have a lock-in period that up to certain years you cannot sell your shares. They will naturally be there in the company either as shareholder or as director until that lock-in period is there. What they will do after the lock-in period, they may sell off the shares. So after that, they may want nothing to do with the company. So that means what happens is subsequently it is possible that the promoter group can change. For example, let's say for example there is I know of a listed entity which is actually forming part of a German-based MNC group. Okay. Now what happened is the German MNC was acquired by a France group. So what happens is the promoter group itself has now changed from one entity to another. Okay. So what we need to see is what are the latest filings available? Who is defined as a promoter in that filing? That we have to check for the purpose of this definition.
So now we will not take the.
No, we need not take till the. No.
Promoter group can be changed.
Promoter group can change, sir. Okay. It can change. We need to refer to the latest available filings.
The name is a misnomer. Promoter means we think the date 1915, 1969, 1990 like that. So this definition is different.
Yeah.
Promoter is defined by Companies Act Section 269. It says that whoever is being named as a promoter by the company
Correct.
Annual filing.
Correct.
92 section is an annual filing.
Correct.
Somebody who is named as a promoter, I think
They are the promoters.
As per the details of formation.
Yes. Okay. So any person or any entity. Now the next deemed related party is any person or entity holding equity shares of 10% or more in the listed entity, either directly or on a beneficial interest basis at any time during the preceding financial year. Very honestly speaking, SEBI has gone literally overboard in defining who are all related parties. But see, if you ask me, these things are a little tricky to address in terms of disclosures or things like that, because see, it is a little difficult to track at any point during the financial year who has exceeded a 10% holding, all that. So as companies grow or as the nature of the entity changes, the risk of reporting and review also increases multifold. So, we'll probably have to be careful about this deeming provision which is available in the Nodal regulations. Okay? Now,
Maybe you will get the people holding 10% shares through some external service provider. There are people who maintain such an.
yes, ma'am, we will.
But this beneficial interest, how do you?
It is a little difficult, ma'am. That is what I am saying. It is difficult. First one is easy. That I agree. Second one is very difficult.
It's a
Similarly, the AS24 definition where you mentioned the influence directly or indirectly. As an auditor, how do we establish that influence which is direct or indirect?
Professional skepticism, if I can put it like that. Madam, see, direct cases you would be able to ascertain. See, like we said, we have been discussing this, a couple of times now. That our normal thumb rule is that we will take that if 20% or more shareholding is there, then we are going to consider it as an associate, because we assume that there is a significant influence. And if it is more than 50%, we assume that control exists, hence it is a subsidiary, right? So we construe it as a related party at the face of it itself, right? Now, indirect could probably mean, a case where, for example, there is one entity, it has a subsidiary, that subsidiary has another subsidiary, beyond that it cannot go because of the restriction available on the number of layers. So, what does the ultimate holding company, what is the percentage indirectly it holds in the last entity available? Maybe that could be one way of saying indirect holding. Again, holding as this thing, if you want to check, it is possible to check, because groups today have a good system of tracking what are the entities available in the group, who holds what, how many shares. All that is normally well documented. But beneficial interest is very difficult to ascertain. How will you know if one entity has assigned an interest to another entity, but it holds the shares of that entity? You will never know. It is very difficult to ascertain. The only thing is, if at all a situation comes up where you are able to ascertain, you should not have a question as to whether you have to treat it as a related party or not. Hence, the standard covers it. That's all. If at all it comes to a fact that, see, today you have tools to ascertain a lot of things. If it comes down to the fact that, well, you now have the database to see who are the beneficial interest holders or anything like that, okay. Get it, disclose it as a related party, move on with life. That's it.
Only one audit in 1 year you can do if you are going to do like this.
By that time we will get several other tools to do audit also. It's just that we need to be equipped with it, that's it. That challenge is always there. Now, what are RPTs? We have seen lock, block and barrel, we have seen what is related party. Now, what are related party transactions? Let us look at that. Again, we are going to see everywhere in our presentation today, we are going to see Companies Act, AS, Ind AS, SEBI. That's how the entire theme is going. So, under Companies Act, very great. Not at all specifically defined. Section 188 does not say anything. There is no definition under Section 2 for related party transaction. We can be the happiest people on earth. But we can infer something. How Section 188 gives you certain transactions which require approval of board members or audit committee where it is applicable. And in certain cases, if it meets some certain threshold criteria, then you might have to get an approval from the shareholders as well. Okay. Some of those examples are, sale, purchase, leasing of premises, or appointment to a place of profit. Those things are some of the related party transactions which are indicated in the Companies Act. As per the AS18 defines related party transaction as transfer of resources or obligations between related parties regardless of whether the price is charged or not. So there is you need to have a transfer of resources or obligations. What do you mean by obligations? Guarantees, commitments, right? So you might not give money or money's worth, but you can give a commitment, you can give a guarantee. So these are obligations. So when there is a transfer of resources or obligations between related parties, whether the price is charged or not. So like I said before, AS18 and Ind AS 24 does not bother about accounting, measurement, recognition, it does not care about that. It is a disclosure standard. Do you have a transaction? Yes, disclose it. That's all. Very simple. Okay. Now, Ind AS 24 is the latest standard. So it is a little bit more expanded. You will see only one additional word there. Transfer of resources, services and obligations between a reporting entity and a related party, regardless of whether the price is charged or not. So, not a major difference, but the standard wants to be abundantly clear as to what all gets covered under related party transactions. Okay? By resources, do we mean only physical goods or goods that need to be moved? No, it can also be services. Okay? So, this is under Ind AS 24. Okay? Next we have SEBI. SEBI gives a in-depth definition. A transaction involving a transfer of resources, services or obligations between a listed entity or any of its subsidiaries on one hand and any other person or entity on another hand, the purpose and effect of which is to benefit a related party of the listed entity or any of its subsidiaries. This is more or less like how we are treating associated enterprises in Income Tax Act. So it is not just a direct transaction between a company and its subsidiary or associate. If you are transacting with another company, let's say A and B are related parties. A is the holding company of B. B transacts with some XYZ private limited. What happens? The price of the transaction is determined by A. Which means, effectively speaking, B and XYZ are related parties. Very strictly speaking, as per this definition, B and XYZ are related parties. Okay. But we do not normally disclose things like that, because again it is very difficult to ascertain whether A has a say in determining the price of a transaction or not. And if so, even if A has determined the price of the transaction, we always have a rider clause over here saying, if it is for the benefit of the listed entity or its subsidiary. So when that comes up, it is very difficult to establish this particular point. Hence, whatever we normally give under Companies Act or Accounting Standard, that holds good for SEBI purposes also. Normally speaking. Okay. If you find any exceptional circumstances, my number is given here. You can always reach out to me. Okay. So these are related party transactions. Now, SEBI regulations will not stop with just a simple statement. They will go even more further. Okay. Now, determination of the related party transaction, it does not bother whether you have charged the price, whether it is a single transaction or a group of transactions in a particular financial year. Even if it is one transaction, whether you have charged the price or not, you still take it as a related party transaction. Should I disclose or not? You will see later. It is a related party transaction, that's all. Now, there are some specific transactions which are excluded from the purview of RPT. Dividend. Okay. The listing regulations very clearly says that payment of dividend or issue of bonus shares, rights issue, buyback, these are not specifically to be considered as related party transactions, but you need to remember something. It should be available to all the shareholders, or at least a common group of the shareholders. Okay? And see, normally these transactions happens to either most of them or all of them or none. You can't say dividend I will give only to one shareholder and for others I will not give. That is not the case. At least in any of our regulations currently available, it is not the case. So these are excluded from the purview of related party transactions.
But in case of 100% holding, normally there will be only one shareholder. So we are giving the dividend to that. So whether we need to disclose that transaction.
So see, even in that case, you don't have to disclose that transaction because it is again being made available to whoever is shareholder, everyone is given, that's it. Whether it is 1 or 100 or 1000, you are giving it to everyone, that's all. So, and see, honestly speaking, dividend is normally not treated as a transaction for the from the perspective of a related party transaction. Why? Because it does not affect your profitability or anything like that. It is just accumulated profits which are distributed as a result of operations, right? Somewhere, if I am in a partnership firm, I take a share in profit. If I put my money in a company, somewhere or the other I need to take some money out of the company. That is why I am putting my money in the first place. It is basically a reward for the risk taken by the investor. So it is not treated as a related party transaction from legal perspective. Then issue of any securities on a preferential basis under but again that is subject to compliance with the ICDR regulations. Acceptance of FDs by banks or NBFCs from again related parties, provided it is in uniform terms. If you are accepting it at the same terms from all other parties at stake, then you can just simply probably you will have to report it to the stock exchange. That is always there. But it can be excluded from the purview of RPT for the limited purpose of SEBI regulations. Companies Act, Ind AS is not saying on this. Okay, all of these exclusions are only from the perspective of law and regulations, not from the purview of Companies Act. Okay. Now, very quickly, we will in just about 5-10 minutes, we will just cover in brief what are the approval mechanisms for RPT. Yes, ma'am. Okay. So, see, SEBI, the order regulations actually, in that, the definitions, you have a very clear rider clause which states that the definition of this related party under the order regulations is not applicable to a mutual fund listed under the stock exchange. Sorry? Very honestly, I am not sure. I will be very honest with you, I do not know. There are some things left better unsaid, if I can put it like that. So, see, this thing, probably it is because, mutual funds mandatorily have a couple of RPTs which have to go without being sent. Because a mutual fund will not just consist of only one entity, there will be a couple of entities which work together and only finally perform. So probably because of that they do not want to control any it could be because of that. Okay. Yes, ma'am.
I have a holding company.
Okay.
A sales senior person is coming down to India to discuss a big deal.
To discuss a big deal, okay.
Use the mic, please. And he is fixing the selling price.
Okay.
Of the whole big deal.
Okay, so KMP of a holding company is coming to India to fix the price of a contract for the company in India. Okay.
Will that transaction be a related party transaction?
Is this company a listed company?
No.
No. That means law and regulations and all is not going to apply for you. Okay, under Companies Act, that transaction is not covered under the purview of an RPT. Under the Ind AS or AS, it is not considered as an RPT. For the purpose of income tax, in transfer pricing, it may be covered as an international transaction under 92B.
Thank you. Thanks.
Okay. But again, we'll have to check the facts of the case. We can't straight away just declare something. We'll have to look into it. Okay. Now, approval mechanisms. Now, another? Sorry? No, you said KMP, no?
He was an ex-KMP. AMP. He was used to be India's director.
Okay, we'll take it offline. Okay, so now approval mechanisms of RPTs. Under Companies Act, okay, all RPTs require board approval. Okay, under section 188, you need board approval. Wherever an audit committee, I am not going into 177 or Rule 6A requirements because this is not our primary importance in today's session. But nevertheless, I just wanted to brush up on those points as well. If a company is mandated to have an audit committee, then under the section 177, read with Rule 6A, you would have to, Rule 6A of the company's meetings of the board and its powers rules. You will have to obtain approval of the audit committee. The audit committee in certain instances, subject to compliance with certain requirements, can also provide an omnibus approval for transactions for an entire year. Okay, there are certain conditions which probably we can discuss later. If you have any doubts in that, you can always reach out to me later. Okay.
The audit committee go into the arm's length mechanism also while authorizing.
Sorry?
The audit committee go into the arm's length pricing also.
So normally audit committees will do that because they are they are given those those would probably form part of the terms of the audit committee at the time of appointing them. So because they are they are only approving and recommending those RPTs to the board for the final board approval, and subject to if they meet certain threshold criteria, finally it will go to the shareholders approval. So they would have to assess. See, audit committee, when an audit committee applies, it is very abundantly clear that probably those companies would have independent directors. Independent directors are non-executive. They are also like auditors basically. They would want to get a comfort that okay, whatever is happening in the company is reasonably fine. Okay, they might not they would not have absolutely any clue about the transaction-based details, but at least they would, at a very high level, they would want to know what is happening in this company. So, in that instance, they would definitely want to assess how has the management arrived at, arm's length pricing. Is that really valid and reasonable? Those things would be assessed by the audit committee before they, give their approval for it. Okay? Now, coming back to, yeah.
The transaction is at arm's length and it's entered during the ordinary course of business, then also approval is set, right? Or it's not yet?
So, are you asking in a situation of audit committee or no audit committee?
With audit committee.
With audit committee. So, see, if it is at arm's length, at least, they just need to be notified about it at least, as a good governance practice. You see, as per law, there are some exceptions that you don't have to report it. There are some exceptions, but as a good governance practice, even company secretaries, if any available here as well, I have at least seen that they normally recommend that we just at least disclose it and mention the fact that these are the terms then and this is how we have arrived at it. It is just looking at how much of a governance how better we can make our governance policies and how better we can make our vigil mechanism. So that is the only thing which is required. Okay, that is the entire objective of actually framing an audit committee. See, whatever the board has to do, they are delegating a part of that work to the audit committee, but finally board assumes the responsibility. Financials are not approved by the audit committee, they are finally approved by the board. But they have given certain powers and terms to the audit committee only to specifically, check with better diligence. Because board members again may or may not be aware of everything that is required. Audit committee members may be different from the board members, and they may be more than different, they may be more aware of the requirements of financial reporting, accounting standards, auditing standards, etc. So they would be more inclined to assess these things much better, which which basically boosts the confidence or the integrity of the company in the eyes of the shareholders or other external stakeholders. Okay, it's all part of a good governance.
Sir, arm's length is applicable for salaries also?
No, sir, you can't put up an arm's length for salaries.
Especially directors or senior.
You can't. You can't. It is not possible to see, because see, when you are paying a director, see, if you are having if you are, say for example, you are paying to, I'm keeping it very simple. Okay, let's say you have a senior advocate who is running his legal practice. Okay, or a corporate advisory company. Okay, he may have his son as a employee. At the same level, there may be a totally unrelated person who is employed. Now there you can compare the salaries and say that whether it is at arm's length or not. But for the director himself, you cannot determine whether his salary is at arm's length. He is the one who is running the show. He is the one who is taking the risk of running the show.
For the directors, the company side probably directly takes care of that. What the ceiling 188 is there.
It applies only to public companies. Private companies, you can't. Any public company, 198 will apply. Limits under 198 will apply. Okay. So, RPTs require board approvals. You have certain conditions under Rule 15. Basically says what are the, how do you present it to the board, what are the, in the notice what all you should put in, and certain other secretarial requirements which would be there in Rule 15. Then certain transactions exceeding a particular limit would require an ordinary resolution at the general meeting of the company. Voting should be done only by non-interested members. If the member itself is a related party, then they should abstain from voting. Again, basically, to avoid any conflict of interest. Okay. Now, member approval is not required in certain cases. When if there is a government company which is transacting with another government company, both are run by the central government, hence they are related parties, get approval from the board of directors. Makes no sense. So they do not require any approval from the board. Or it is a transaction between a holding company and a wholly owned subsidiary, and the accounts of the wholly owned subsidiary are consolidated with the holding company and placed before the shareholders at the general meeting. What happens is these things are already disclosed when they are placed for approval of the shareholders. Hence, it does not require a separate approval, is what is the logic. Transaction by an, I honestly don't know to what extent this applies, at least I have not seen it in my experience. So, transactions by an unlisted government company where approval for the transaction has been obtained from the concerned ministry or department. I have not interacted with too much of government companies in my experience, and hence I might not be able to give you too much of examples or guidance on this particular point, but this exemption is available in section 188 of the Companies Act. Okay. Now, we said shareholders who are not interested in the particular transaction only are eligible to vote. Now, does it apply to every case? No, there are some exceptions. What are they? If it is a private company, let us say, there is a brother and sister who are running the company. So, it is being run in the premises of the, say, sister's husband. Rent paid to the sister's husband is a related party transaction. It exceeds some particular limit. It requires the approval of the shareholders. Only brother can vote, sister cannot vote. Doesn't make any sense. Okay. Or like I think Sir had raised one valid point that there is a holding company and wholly owned subsidiary. What is the point? There is I mean, see, the sole shareholder will be the holding company. So if that person abstains from it, there will be no one to approve the transaction. Doesn't make any sense. So better, don't have a, you don't need a shareholders, you need a shareholders approval, but even the related parties can still vote in the case of a private company. Specified IFSC companies. So in order to boost the incorporation of companies in the IFSC zones, there have been several exceptions and allowances given to IFSC companies, and hence this is one of them. Government companies, government shareholder approval need not be that non-related parties only will be allowed to vote. Company where 90% or more members are relatives of the promoter, or they are related parties. If 90% or more of the members are related parties, everyone can vote, no problem. Who is to stop? No one is there to stop. Vote, finished. Okay? Now, which are the transactions, that is, in what instances do we need shareholder approval? Approval means ordinary resolution in the general meeting. So, in case of a sale, purchase or supply of any goods, material, if it exceeds 10% or, if it is 10% or more of the turnover of the preceding financial year, then you will have to get an approval in the general meeting. Selling, disposing or buying property of any kind, if it is 10% or more of the net worth of the company in the preceding financial year, please get an approval of the shareholders. Leasing of any property, availing or rendering of any services. If it is 10% or more of the turnover in the preceding financial year, please get an approval. Above limits apply to transactions to be entered individually or taken together with the previous transactions in a year. Okay? Basically, whether it is one transaction or cumulative of everything, you have to look at the limits like that. Okay?
If the network is negative, then
still you can take the absolute value also, sir. In either case, it will still exceed 10%, obviously.
Some company in the first year of operation they will not see turnover.
You are saying for first year companies, probably the net worth might be zero because they might not have significant operations or probably no operations also. Why first year companies? Entities which are still under construction, if they are constructing a major factory, probably for 2 years they might not have any sales. That is what you are saying, right? So, in that case, net worth would be negative. So, we have to basically, the Act doesn't say, you take the absolute value. Okay. You can even take the 10% of the negative value, then by all means, every transaction you will need a shareholder approval. Doesn't make sense, but still, that is the law, ideally speaking.
Anything over and above zero is
yeah, that is what I'm saying. Appointment to a office or place of profit in the company, subsidiary or associate, where the monthly remuneration exceeds 2.5 lakhs. Monthly remuneration exceeds 2.5 lakhs, then you will have to get a shareholder approval. Let's say, for example, you are placing a director as another director in a subsidiary, and if his remuneration in that transaction exceeds say 2.5 lakhs per month, then you will have to get a shareholder approval because it is at RPT and it exceeds that limit, so you will have to get a shareholder's approval. Remuneration for this last line I have not seen too much, okay, in my experience. So remuneration for underwriting the subscriptions of any securities, if the transaction value is more than 1% of the net worth in the preceding financial year, you will have to get a shareholder approval. So what I understood from this is that But see, normally whenever we go for listing or when we are issuing any securities, be it shares or debentures or whatever it is, when whatever underwriting happens, you have merchant bankers who take care of the underwriting. So I have not seen this particular transaction in my experience. If anyone in the audience have seen it, if you could share your experience, maybe we could all benefit from it.
Regarding the appointment, monthly remuneration 2.5 lakhs. Probably to discourage people doing the RPTs or considering today's environment, 2.5 lakh is some officers that also get.
Sir, that 2.5 lakhs will be only from that particular appointment, sir.
That's right. Probably the draftsman would have thought to discourage it, they kept it very low.
Correct. But yeah, you're right. To just discourage it, probably it will be kept at that limit. Correct.
Is that applicable for private limited companies also?
Which one, sir? This requirement to. Yes, sir, it is applicable. Okay. Now, under listing regulations, all RPTs require audit committee approval. If we are talking about listed companies, obviously they will have audit committees. So they need an approval, and again, subject to certain listing, it could be a omnibus approval as well. Listed entities should formulate a policy on the materiality of RPTs. Okay. And so most of the transactions are covered actually. There are very few which are not, something like sale of a property or something like that. Those things will not normally. Yeah, business combinations. Things which are, a little unique or, something which is normally not recurring, they are not covered under the omnibus approval. Okay. So, listed entities must formulate a policy on the materiality of RPTs, and they should, in determining the materiality, they should also define their thresholds. For every entity, it can be different. Okay, and this policy must be reviewed once in 3 years. It must be placed in their website. Yeah.
If you look at it, already 10% or 20% for material subsectors, or whether it's separate from the policy, what?
No, if you want to keep it lower.
Below the 10%.
Yeah, if you want to keep it lower. No one will do it, but still highly doubtful that there are any companies which are doing it lower than that, but still, if you want to do it, you can do it. You cannot do it more than 10%. You cannot set it like that. Otherwise, you are in blatant violation of the regulation. So, for want of time, I will skip the remaining portion. We will get into the final thing, disclosure requirements. See, this we have already discussed. Why we need this disclosure, particularly with respect to related parties, to ensure there is a transparency, to ensure that we are able to say, because these transactions normally have a impact or effect on the profitability or financial position of the entity. Okay. Now that is the main reason, and apart from that, if you see here, there are in Companies Act. What are the disclosures? There are some non-financial statement disclosures. That is, disclosures which are not required which are not there in financial statements, but they are available elsewhere. For example, under 184, if a director is interested in a related party transaction, he should abstain from voting on that in his board approval. Again, for private companies, especially IFSC companies, those exemptions are available. Okay. Then, under 134, in the board's report, you need to provide what are the related party transactions under Form AOC2. Okay, and a register under MBP 4 needs to be maintained. Which contains what are all the arrangements with the related parties. Those have to be maintained in MBP 4. These are non-financial statement disclosures or reportings. Now, in financial statements under Schedule 3. Each item in the balance sheet or P&L, if there is a transaction with a related party, you need to clearly indicate it. For example, loans and advances with KMPs or related parties. What is the total amount of outstanding? What is the proportion to the total loans outstanding? You need to give that. Okay. Now, very important thing, both given in Companies Act and in Standards is that is maintain a balance between over disclosure and under disclosure. Over disclosure should not confuse the people. Under disclosure should not be the case where user does not understand anything because he cannot take any information. Only if I give you will find out. No, I won't give you anything. Don't do like that. That is the only. Sorry. Yeah, that is a different story, sir. Now you are talking like an auditor. I am talking like a management being. Now, additional, couple of years back, Schedule 3 came out with some amendments. So the additional requirements under Schedule 3 were, amount of loans and advances in the nature, or advances in the nature of loan outstanding, to related parties have to be specifically disclosed along with the percentage of the total loans. And any CSR contributions to a related party has to be disclosed separately under the CSR note. Okay. AS 18. I'll just quickly go through key points. Okay. Name of the related party and nature of relationship, whether you have transaction or not, if control exists in that particular related party. For example, holding company, ultimate holding company. Sorry, not ultimate holding. Holding company, for example, if you take, control exists. I do not have any transaction with the holding company. No problem. Disclose the name and relationship. It is compulsory whether you have any transaction or not. If control exists, you need to disclose the name and relationship. Now, for all other parties, if you have a transaction, disclose the name and relationship, and then you give details of the transaction. How much is the amount? What is the nature of the transaction? Do I have any provisions for that? What is the year-end balances? Have I written off any amounts from the balances, or have I written back any of the balances? All that we have to give. And the standard also allows you to aggregate based on some groups. Like for example, if you have common control, then you can just aggregate, maybe there might be 100 related parties for some big, large corporations. So in that case, you can just aggregate all of them and put it under one bucket called as entities under which are having common control. And or you could choose to disclose it one party at a time. It is up to you. Standard gives you the option. Okay. Ind AS, same thing available. Only a couple of differences are there. Parent and subsidiary relationship name to be disclosed because control is existing. Whether you have a transaction or not, you need to disclose. Okay. Other entities, only if you have a transaction, you need to disclose. Okay. Now, very important, another compulsory disclosure is that you need to disclose your parent, that we have already seen. Ultimate holding company, you have to disclose. There may be some cases, because Ind AS allows this, or IFRS allows this. There may be some cases where your parent, immediate parent might not consolidate, or the ultimate holding company may not consolidate. There may be someone in between who will consolidate. So, if your parent is also not consolidating, your ultimate holding company is also not consolidating your accounts, that means there might be someone in the middle who is called as an immediate next senior parent. So, immediate senior parent. That entity's name and relationship also you have to disclose if it arises like that. Okay? This is purely a disclosure requirement only to suggest or indicate to the users of the financials that this is the entity which is consolidating in the group. Okay? Sorry, ma'am?
What are the cases in which the next parent or next? Everybody says that there is a next level. There is a holding company.
Company X, holding company, is called as a parent. Parent of parent, ultimate holding company. Maybe ultimate holding company may not consolidate because all of this is immaterial to it. And its local laws and regulations allows to not consolidate also. Parent may not consolidate because the subsidiary itself is immaterial. Or maybe maybe because each parent is consolidating this entity, the immediate parent may not consolidate. It might always arise because Ind AS allows it to do like that. Sorry? Okay. So, one more thing is that specific disclosures for KMPs. Okay? You need to disclose short-term employee benefits, post-employee benefits, other long-term benefits, termination benefits and salary-based payments. All of these we have to separately disclose. Okay? Again, if you are obtaining the services from a management entity, that you need not categorize like this. In that you can simply put amount paid to KMP availed from management entity, so much amount. You can just put, say 1 crore, 2 crore, whatever it is. But if it is a KMP on your own roles, you will have to give this breakup compulsory. Okay? So yeah, more or less the same thing as per AS 18. Apart from this there is no other difference. So like I was mentioning, the only other difference between AS and Ind AS is that you have a exemption available for government entities. Okay? So if you avail the exemption, what happens is only these need to be disclosed. Name of the government and nature of the relationship with the reporting entity. Okay? And nature of relationship means, does it have control or joint control, or does it have significant influence with the reporting entity? What is the relationship? And you can probably give certain details of the transaction. It is again subject to the judgment of the management, and probably auditors will have to use their professional judgment to validate whether these exemptions can be applied or not. Okay?
In case of KMPs, you listed something, can you go to that?
Yes, sir. Sir, please don't worry. You can. There's a QR at the end of the slide. You can just scan it and you will get the PPT to your phone. Okay? Don't worry. Now, lot of regulations is the last of the lot. Okay? So, lot of regulations requires certain additional things. Okay? Regulation 27 requires that a quarterly compliance report on the corporate governance containing details of all material transactions with related parties needs to be submitted and filed with the board. Regulation 46 requires that the policy on materiality of RPTs needs to be uploaded on the company's website. And Regulation 53F, read with Schedule 5 of the Order Regulations, requires disclosure by name and amount of loans and advances. What is the total amount that is outstanding at the year end? Most of this already we give under Companies Act or AS, Ind AS, etc. It's just that again SEBI is mandating a requirement to cover all possible scenarios. Okay? That, sorry.
Corporate governance.
Yes, ma'am.
Transaction, should we mention that there is no material transaction?
If you do not have a material transaction, then normally companies are tending to file like that also. Some companies go ahead with filing like that. Because anyhow this quarterly compliance report will be there. Apart from that, they mention in that report saying that we do not have material transactions. Okay. So this side you can scan this code if you can directly save my contact details, and with that one you can get the PPT to your phone. Okay. So thank you everyone.
Thank you, sir. Thank you for valuable insight on disclosure of related party transaction. I welcome Veenaa Venkatesh to occupy dais. It's my pleasure to introduce Ms. Veenaa Venkatesh. Is a practicing chartered accountant handling taxation-related assignment. She has been practicing independently with predominant focus in GST compliance, litigation, and advisory. He has the speaker in session conducted by ICAI Hindustan Chamber of Commerce, Andhra Chamber of Commerce, and International Chamber of GST Professionals. He has authored various articles on different contentious issues in GST law that have been published in leading tax journals. He is also a guest lecturer addressing school and college students on different topics related to taxation. Thank you, ma'am, once again. Hand over to the speaker. Sorry, I request Purnima ma'am to present the memento to the speaker. Hand over to the speaker.
So like I was saying, once it is concluded that there is a transaction between related persons, for valuation we have to look into Rule 28, and the first method prescribed under Rule 28 is open market value. So if there is no open market value, then the next method is value of supply of goods or services of similar kind or quality. So in the example where I was saying that a mobile phone is given to an employee, suppose if the very same model is not given to an unrelated party, if we have a similar phone with similar specifications or similar features, then we could adopt the value of such mobile phone. If that is also not available, then in case of goods, the next option is Rule 30, which will say 110% of the cost of production. For services, you can either opt Rule 30, which talks about 110% of cost of provision of service, or you can directly go to the residuary provision, which says by reasonable means. Of course, by reasonable means they have not mentioned anything. They only say it should be something similar to the methods prescribed under Rule 28. Now under Rule 28, there are two provisos. These provisos have been there in the rule right from July 2017. So the first proviso says, if the supply to the related party is supply of goods, and if those goods are further going to be supplied as the very same goods, then the value to be adopted, or at the option of the supplier can value that transaction at 90% of the price which the recipient will be charging from his ultimate customer. So I repeat, only in case of supply of goods, and if it is a case where the goods are intended for further supply as such, that is, there shouldn't be any value addition. Whatever he procures from his supplier related party, he should give the very same goods to an unrelated party. If that is the case, then whatever value he is going to recover from his customer, on that 90% can be assumed as the value of this supply. So this is first proviso. Second proviso says, where the recipient is entitled to full input tax credit. So ITC is input tax credit. If he is eligible to claim full ITC, then whatever value you mention in the invoice is deemed as the open market value. Let us understand the logic behind this proviso. And before going into that, there is no particular order between these two provisos. First proviso is applicable only to goods. Second proviso applies to both goods and service. And the supplier can opt for either of these provisos without, even for goods, without adopting the value as per proviso 1, he can directly go to proviso 2 also. There is clarity in this regard. So when they say full ITC, the logic or reasoning is, assuming the supplier is going to supply for 100 rupees and charge 5% 5 rupees from the related recipient. That recipient is going to further supply at 150 rupees, and let us say it is again 5%, 7.5. So now for the first supplier, for the first supply, the supplier will pay 5 rupees. For the second supply, the recipient or the related party will pay 2.5 rupees in cash, and this 5 rupees he will take it as credit. So his payable will be 7.5, out of which 5 he has already paid his supplier, so he will take it as credit. Use that credit for payment. 2.5 is what he is going to shell out. Suppose instead of 100, if he is going to charge say 10 rupees, and if the tax value is 0.5, then what happens? He will pay 0.5. In any which case, because this transaction is not between related persons, he will be supplying to an unrelated person at 150 only. So the tax payable is 7.5 only. If it is 0.5, his ITC is restricted to 0.5. If it is 5, it is restricted to 5. So if it is 0.5, he will pay 7 rupees in cash. Ultimately, government is getting 7.5 only. So that is the reason they say, if the recipient is entitled to full ITC, then whatever value you charge in your invoice, it is deemed to be the open market value. We will blindly go by that value. So it can be one. In fact, there are clarifications or circulars where they say, if in case of related party transaction where there was no consideration, they failed to treat it as supply under Schedule 1 and failed to pay tax. If it is a case where otherwise the recipient was entitled to full ITC, then it is deemed as if 0 is the open market value. They deem it to be nil value because, like I said, whether it is 10 rupees, 1 rupee, 100,000, 1 lakh, it is not going to matter because ultimately government is going to get its share either from this supplier or this recipient. So this is the logic behind this particular proviso. So this proviso has been there under Rule 28 all along. So they say, yes, if it is a related party transaction, valuation is as per Rule 28, look into open market value. If it is not there, then go to the other methods. If that is also not there, you have two provisos for your benefit. For goods, it is the first proviso. For both goods and service, second proviso is available. But second proviso you can adopt only if you satisfy the condition that full ITC is available. So here there are doubts as to at what point in time you should check the eligibility. Because there could be a scenario where at that point in time when you are receiving that service or goods, it may so happen you are involved only in taxable supplies. So you may be entitled to full ITC. It could so happen that going forward in the future, you may start making exempt supply also, or because of some notification, the goods may become exempt. Once it is a case where you are rendering exempt supply, then the automatic question of ITC reversal comes. So if it is a common credit, of course if it is an exclusive credit, then no doubt. If it is for taxable supply, you are very clear full ITC is available, any value will be the open market value. But I am talking about a scenario where the supply between related parties happens to be a common supply used for both taxable, common input for both taxable and exempt supply. Then you are entitled to take credit only to the extent of taxable supply. To the extent it relates to exempt supply, you have to reverse ITC. If that is a scenario, the benefit of proviso under Rule 28 cannot be extended. So the question comes, it may so happen that the invoice would have been issued in March. You may defer it and avail it in October because the law itself provides that you can avail it till November. When March, you are doing only taxable supply. It could so happen by the time you avail in October, maybe there is another line of business where it is an exempt supply. Say for example rent. So in rent, it is very difficult to say I use exclusively for taxable or exclusively for exempt. Or even if it is a legal service or audit service, always these type of services tend to be common services for both exempt and taxable supply. So in those cases, there seems to be or there appears to be a difficulty. One possible view or position which we can take is, because of the wording, we can argue that the eligibility has to be seen at the time of issuance of invoice. Because the proviso gives this benefit to the supplier. It says, if the recipient is entitled to full ITC, then any value disclosed by the supplier is deemed as open market value, because this valuation we are seeing from the supplier's perspective. So we can take an argument and say, at the time the invoice was issued, had he availed the credit, he was entitled to full ITC. Going by that, the value which I have adopted is open market value. But these are all questions which have to be tested. These are all possible issues or areas which are likely to be disputed, which I am highlighting. But there is an argument which we can take saying the eligibility of ITC has to be tested at the time the invoice is issued.
The company makes exports and also domestic sales. So part of it is zero rated, but it is not exempt. And there is a consultant who has to bill us for some little less than 20 lakhs. He is unregistered and he did not give an invoice and he flew abroad. Means, can I do a self-invoice and avail credit by paying reverse charge? What the problem coming from invoice not being issued in 6 months?
So, if I am right, you are talking about a scenario where it is a legal service.
It is a consulting service.
Consulting in the sense an auditor, because only legal services is under RCM. If he is not an advocate, if it is not a firm of lawyers, then RCM will not apply.
No,
so
if still he is an unregistered dealer, can I issue a self-invoice?
If he is unregistered, then there is no question of paying GST at all. The question of paying GST comes only if he is registered. If he is registered under forward charge, he has to issue the invoice. RCM, there is a specific...
He went abroad without giving an invoice and still carrying a provision.
This is only consulting, no, madam. So long as it is not legal, you need not be worried about paying under reverse charge. Because reverse charge notification notifies the categories of services for which RCM is applicable.
But if he is a related party, then consultant.
If he is a related person, then by virtue of Schedule 1, it is supply between related persons, so you have to pay. Even there, he is the one who is liable to pay as a supplier. For recipient, the liability kicks in only when we prove that under section 9(3), subsection 3 and subsection 4, where there are notifications issued, which specifically includes within an ambit, I think around 16 or 17 services. Only for those services RCM will apply. It is not a case where if any and every supplier is unregistered and you are registered, automatically RCM is applicable. No. Even this renting of commercial property that has been included in this notification as entry, I think 6AB or BB if I am not wrong. So this notification which I am talking about is notification 13/2017 under central tax rate. So there is a similar notification under every state and as well as IGST. I think under IGST the notification would be 10/2017. So you can refer to the notification. Only if the nature of service is covered under that notification, RCM notification, then the liability to pay under reverse charge arises. Just because he is unregistered, there will not be any liability. But assuming in your case, if it is a legal firm and if RCM is applicable, yes, because of this circular, now you can issue an invoice, pay the tax along with interest. Of course, penalty you need not pay until and unless they issue a notice. Pay the interest, claim credit based on this self-invoice. Because of, I included that circular also, because of that you will be entitled to ITC. So, as we saw under Rule 28, there are two provisos. First proviso for goods and second proviso for goods and services. Now, there is another decent insertion under Rule 28. Sub-Rule 2 has been inserted. So, Sub-Rule 2 is a case where it provides the valuation mechanism in case of corporate guarantee issued on behalf of related persons. So, this Rule 28 Sub-Rule 2 is relevant only where corporate guarantee is given by a related person to the recipient who is located in India. That is very important. That is why I have highlighted in red. And this guarantee has to be specifically given to banks or financial institution. If any other loan borrowed is guaranteed, then that is not covered under the valuation under Rule 28. Rule 28(2) is specific to a case where corporate guarantees are given and the recipient is located in India. So what this rule says is, this was inserted with effect from 26th October 2023. The portions which I have highlighted in red, they were subsequently introduced in July 2024, but with retrospective effect from 26/10 only. Why I have highlighted is, in 23 itself there was a circular which was issued. After insertion there is a recent circular. So we will be discussing the clarifications in both the circulars, you will understand. So now what this valuation rule says is, in case there is a corporate guarantee issued by it could be a domestic entity or a foreign entity, the only condition is recipient should be located in India. In those cases, by virtue of Schedule 1, even if there is no consideration, they qualify as supply. So tax becomes payable. Assuming there is a consideration, still by virtue of section 15, once parties are related, we automatically go to valuation rule even if there is a consideration. So what valuation rule says is, either the actual consideration or 1% per annum of the total amount guaranteed. Compare both. Whichever is higher, that is the value of supply. On that you have to pay GST. So for arriving at the value of supply, Rule 28.2 says, in case of corporate guarantee, where the guarantee is given to banks or financial institution and recipient is a related person in India, then the value will be actual consideration if consideration is there. If there is no consideration, 1% of the amount guaranteed per annum, whichever is higher. So here again, until July 24, this proviso which I told you, if recipient is entitled to full ITC, whatever value you charge, that will be deemed to be open market value, was not there. Only in July it was inserted, of course, with retrospective effect. So now the question arises, what about situations or scenarios where the guarantee was given before 26th October 2023? So it is very clear, circular also clarifies that only the valuation mechanism has been introduced. All along, corporate guarantee given was to be treated as supply only. There is no change in taxability as such. From July 2017, it is liable to tax under GST. Valuation rules have been specifically inserted from October 2023. One more thing which we have to be clear about is, personal guarantee given by directors is not covered here. Yes, personal guarantee given by director also qualifies as supply under Schedule 1, because in the saw related person explanation as per section 50, director and company are also deemed to be related person. So if a director is given personal guarantee for a loan taken by the company, yes, it will qualify as supply. But there again we have a specific circular where they have clarified the open market value in such cases is 0. Reason being, there is an RBI circular which mandates or which states, if a director is guaranteeing a loan, the bank should get an undertaking from the company that they do not pay any brokerage or commission or anything of that sort to the directors. So this is a circular given by RBI. The reason or logic or intention is, in the name of commission or brokerage, directors should not be benefiting. So there is a mandate. So the circular takes note of this mandate, and it has been clarified that yes, by virtue of Schedule 1 there is a supply. When you go to Rule 28 open market value, because of this mandate, you are not allowed to pay any amount, as a result of which open market value is deemed to be 0. So you need not pay GST on personal guarantees given by directors. Here again there is an exception. Suppose the guarantee continues but the person is no longer the director. There could be exceptional scenarios like that. In such cases, based on an agreement, if some commission is paid or if any consideration is paid to the director, then in those cases they don't qualify as related persons. So whatever is the amount paid, that will qualify as consideration. That will be the value of supply. On that GST would become payable. So there is a circular to this effect also, which I have included. So this is the circular which I was talking about. So it says Rule 28.2 valuation will not apply to personal guarantee. Again, Rule 28 is only a valuation mechanism that does not define whether there is supply or not. The fact that it is a supply flows from Schedule 1. And because of the RBI circular, it has been clarified that they are not allowed to collect or they are not allowed to pay commission or brokerage. So the open market value will be 0. So this is the other recent circular which I was talking about, which was after the insertion of those 3 points which I had highlighted. One was recipient in case of corporate guarantee has to be in India, and the value is 1% per annum of the amount guarantee, and the proviso which says if the recipient is entitled to full ITC, then any value you charge in the invoice will be deemed to be open market value. The logic or reasoning is the same, because irrespective of 10 or 100 or 1000 whatever you charge, if he is ultimately going to take credit of the tax amount, it doesn't make a difference. But again, when you say full ITC, the question arises as to what point in time you should see, because most of these guarantees will spread across a number of years. And in guarantees, it could be a continuing guarantee or it could be a case where it would be subject to renewal periodically. So this circular is quite comprehensive, where they have covered most of the points. So firstly, what the circular says is, prior to the insertion of Rule 28.2, the provision or the corporate guarantee given by the related party was still deemed to be supply only. So in those cases, valuation ought to have been done by Rule 28.1, because 2 was not there. So when we say Rule 28.1, again we go to open market value. If open market value is not there, then stepwise, or if there is a possibility of taking the benefit under second proviso full ITC, then any value could be the open market value of the supply. Secondly, it says the value of supply is not dependent on the amount of loan. So it is very clear, Rule 28.2 says it is 1% per annum of the total amount guaranteed by that particular person, irrespective of the loan amount. So if suppose it is a case where you provide guarantee for a partial amount, or if there is a co-guarantor, then all those cases, when we arrive at value, we have to be concerned of only that portion of guarantee which the related party is giving. So only to that extent 1% per annum will be computed. Secondly, this particular provision will not be applicable if the transaction is vice versa, where the person providing the guarantee is in India and if the recipient is outside India, then Rule 28.2 will not apply. Schedule 1 will still apply. So it will be deemed to be a supply. But whether can we say it is an export? There is a doubt, or there is some kind of anomaly there also. Reason being, export of service is defined where they say location of supplier is in India, location of recipient is outside India, place of supply is outside India. Next condition is consideration should be received in foreign currency. So if it is a case there is no consideration, by virtue of Schedule 1 we are deeming it to be a supply. But whether they will be entitled to export benefit is a question, because if no foreign currency is going to come, then there will be a difficulty. So these are all certain open issues which are yet to be answered, which we have to wait, because this concept of, yes, it was a supply all along, but paying tax on corporate guarantee is something which has come to the forefront quite recently. So we can expect a few more circulars along these lines going forward. Then one more clarification which is relevant is, if the guarantor is a domestic company, then the tax is liable to be paid on that supply by the supplier, that is the guarantor only. Only if it is a case where the overseas company is guaranteeing, reverse charge will apply because of import. Otherwise, if it is a transaction between domestic parties, then if the guarantor is in India, he is the person liable to pay under forward charge. Yes, for valuation we will still refer to 28 only. There are few other clarifications also in this circular where they say suppose there is a takeover of loan by one bank to another bank. In those cases, there won't be any explicit GST implication unless and until there is a renewal of the guarantee or there is some additional amount which is given. So long as there is only a name change or difference or transfer of loan itself to another bank, because here we are concerned about a transaction between the related parties, bank is not involved. So if there is a transfer or takeover of loan by one bank or financial institution to another, so long as there is no renewal, there is no GST liability or GST impact on such takeovers. Similarly, when we say 1% per annum, the question arises sometimes the guarantee may be given for a fixed period, or it could be a possibility where as shareholders activity, if the overseas company is going to give guarantee, they may say until the settlement of loan. So in those cases, because it says 1% per annum, we have to multiply it by number of years. So if it is for 5 years, then it would be 5%. Because in case of continuing guarantee, the time of supply is triggered at the time of executing the guarantee. So even though it is for 5 years, in case of continuing guarantee, tax is liable to be paid upfront for all the 5 years. But if it is a case where you are renewing the guarantee year on year, then each year you will pay for that amount. So 1% of the amount guaranteed in the first year, 1% of the amount guaranteed in the second year. So that is how it goes. So you can look into this circular which provides a lot of clarity on these aspects. So I just wanted to mention one authority for advance ruling given by Rajasthan in the case of Green Infra Wind Farm Assets Limited. Here again the company is the company to whom the guarantee was given, that is recipient is located in India, and the company is involved in developing and operating power projects. So as a part of shareholder activity, the overseas company, that is foreign holding company, provided corporate guarantee to banks and financial institutions, and they did not charge any consideration. So here again, like I said, it is a continuing guarantee. It was for the period from the date of sanctioning the loan till the settlement date. So here the issue which was put forth before the authority was whether GST is payable under RCM by the domestic company. If it is payable, should it be paid upfront once or should it be paid on a periodical basis? So here the AR, that is Authority for Advance Ruling, they ruled that here GST is payable only at the time of execution of the corporate guarantee, considering that it is in the nature of a continuing guarantee. That is, the guarantee is given only once and it is valid for the full tenure of the loan. And they also said, yes, because the guarantor is outside India, it is the recipient who has to pay under RCM, and the value should be as per Rule 28. So if it is a case where the guarantee was given before October 2023, then 28.2 will not be applicable. By 28, we have to look into open market value if that is determinable. If that is not determinable, then we have to see if we can take the benefit of the proviso. If the company recipient is entitled to full ITC, then yes, whatever amount they charge is deemed to be the open market value. But if it is a case where guarantee was given after 26th October 2023, then we can adopt 1% per annum of the total amount guaranteed or actual consideration, whichever is higher. Of course, here there was no consideration. So this was. Sorry, sir?
1% per annum.
Per annum.
If it is for 5 years, it is
5%. Because
that 5% has to be paid upfront.
Upfront. They have to pay under RCM.
But if in the middle of the year, if the guarantee is revoked after 2 years or 3 years, then
at the moment there is no clarity on that, sir. What you are asking is quite valid. So what sir is saying is, what if they revoke the guarantee in between? At present there is no clarity on that. As it stands today, it says, yes, you have entered into a transaction with related party, it is deemed as a supply, and for valuation they say it has to be 1% per annum. Suppose if it were a case where it is on renewal basis, then there at least we have some control where we pay only for that period. But if in case of continuing guarantee, that issue is there. So this is another circular which I wanted to refer to. So there was another circular 199 which was issued in case of transaction between domestic parties who were related. So there they clarified saying if full ITC was eligible for the recipient, then nil value, 0 will be the open market value. Because that circular was specifically targeting domestic parties, issue arose whether it can be applied to Schedule 1 import in case where the supplier is outside India and related person is in India. So another circular was specifically introduced to clarify this, saying yes, RCM will apply, self-invoice has to be raised, you have to comply with those provisions. You can take the benefit of proviso also, subject to the condition that full ITC is eligible. Another important aspect is extending of loans to related parties. So we saw about corporate guarantee. There are cases where loans are given to related parties. So as we all know, interest which is payable on loans or deposits or any borrowings is exempt under GST. Be it related person or unrelated person, exemption is there. So similarly, if there is a transaction or loan is extended between related persons, what this circular clarifies is interest portion we are clear, there is exemption. But what about the processing fee or other administrative charges? There could be a case where the related person may not specifically charge any amount for this. By virtue of Schedule 1, should we treat this also as supply? Should we give some open market value to it and pay GST? So here it has been clarified, saying reason the banks charge all these processing fee and other administrative charges is otherwise to understand the credit worthiness of the person who is borrowing. In case of related person, it is quite natural or understood that that specific activity may not be involved. So in that case, if there is no explicit agreement to pay any processing fee or administrative charges, then it is deemed as if there is no supply. But if there is in the agreement, there is a specific clause which talks about these charges. Apart from interest, if these charges are payable, then in those cases, yes, because they are related, then there is a question of referring to the valuation rules. We have to see whether it is open market value, and at open market value, GST has to be paid. So this is with respect to loans extended. So interest, it is very clear, it is exempt. So long as you don't collect anything, you get the benefit that value is 0. But the moment you collect something, like the canteen example, even if it is 10 rupees, the question arises, or we come to a conclusion that there is a supply for which consideration is charged. Because of the relationship, we are compelled to look into Rule 28, open market value, and the supplier has to pay GST at the open market value irrespective of the amount which is actually collected.
But there is a advance ruling in case of Tata Motors. Even in the case of canteen, the nominal value is collected from the employees, still they are eligible to take full credit.
Sir, advance ruling is actually strictly binding only on the applicant. We have n number of rulings. In fact, for the very same person, one particular state they have a favorable ruling, another state they have an adverse ruling. And because of GST, it so happens, I told you the concept of distinct person. So if same Tata Motors say West Bengal held in favor, Karnataka held against, Karnataka unit has to go by that only, West Bengal has to go by their ruling. So that such is the case with respect to advance ruling. Reason I am sharing these rulings here is just to give you an idea or perspective of what are the possible arguments. Of course, when it comes to each applicant, the facts of those cases have to be seen, and maybe if some advance ruling is favorable, we can rely on it for some persuasive value. Otherwise, neither the department nor the applicant is bound by the advance ruling. Like you, sir, I also have another case wherein subsidized canteen services. So this is one recent advance ruling in the case of Federal Mughal by Karnataka Authority for Advance Ruling. So here the facts were that because they were registered under Factories Act, the applicant had to maintain and operate a canteen. So here they had employees, both laborers and employees in the payroll, for whom these services were provided. Here the company procured all the materials, all equipments. They had a dedicated demarcated space for canteen. They were actually operating the canteen. Labor alone was sourced from outside, from a manpower service provider. So that was an input service for the company. Food was prepared and given to the employees, for which a subsidized nominal amount was recovered from the employees month on month. So here again the question was whether GST is payable on the recovery. Secondly, whether they could take input tax credit on the invoice from the manpower service provider. So here if you see, the AAR would have held that the very fact that they are collecting some amount from the employee itself goes to show that the supply is indeed being rendered by the employer to the employee. Because as I said earlier, if Schedule 3 were to apply, you should be in a position to prove that service provider is the employee, service recipient is the employer. Consideration should flow from employer to employee. The moment the employer collects some amount, whether it is nominal, whether it is exorbitant, but once consideration flows from employee to employer, then the roles changes. So here the supplier becomes the employer, recipient becomes the employee. There is no question of taking shelter under Schedule 3. And because of related party, you are compelled to pay tax on open market value. So here the ruling would have said there is no scope of taking umbrage under Schedule 3. It is a supply. And additionally, this input service, the invoice which is issued by the manpower service provider, the company cannot claim ITC also. Recently, if you see for supply of restaurant service, rate notification says the applicable rate is 5%. It is a mandate. Of course, if you see under the classification category, you have another entry at 9%, that is 18% also. But the explanation will specifically say if you qualify as restaurant service or outdoor catering, these canteens, so and so, you are bound by that particular entry only. So you have to charge 5%. It is not an option. For GTA there is an option, 5% without ITC, 12% with ITC. There is no such option in case of canteen. If you qualify as restaurant service, you are bound by 5%. 5% comes with the condition that no input tax credit on input services. If it is the same line of business, yes. But in these facts, it is not the same line of business. Input services, manpower. Output services, food. So, because they have to charge 5% with the condition, ITC is also not eligible. That was what was held in this. So, there are, here also they refer to the Tata Motors ruling, and there are a number of favorable rulings also, but the authority did not consider saying we are not bound by it. So, in your facts of the case, you are liable to pay no ITC. So, going back to Schedule 3, so this is essentially what I wanted to discuss also. So, Schedule 3, as we've already seen, covers only a scenario where service provider is the employee, recipient is the employer. Consideration should flow from the employer to employee. So long as it can be established, if there is something in the CTC to show.
I have a question on corporate loan guarantees given by holding companies which are in foreign country with no consideration being charged. So how is the disclosure to be made in Form 3C, considering that GST's implication is there, so it automatically comes into books. So how is it to be reported in Form 3C?
To be very honest, I am not very familiar about this 3C EB reporting, but because the question of related party transaction arises, you have to specifically disclose, or even otherwise, even assuming GST implication is not there, in any which case you will be disclosing in your notes to account. Maybe you may not create a provision, but at least there will be some disclosure to this effect. See, under GST, all along it has been a supply. The recent clarification is only with respect to valuation, where they say because when we look into open market value, it may not be that easy to adopt some value as open market value because there are other surrounding circumstances or factors which need to be considered. Especially in cases where as shareholders activity, if they are going to guarantee, it may be very difficult. I understand that under income tax, I think under safe harbor rules, they have this 1% or something. So maybe this 1% could have been borrowed from there only to just benchmark to say 1% is a nominal rate. So this 1% which we are talking about is purely for GST purpose only, to comply with GST. Regarding income tax, that is something which have to be looked into separately. I understand, I don't think that is because of GST that will not come. Independently in income tax that has to be shown.
Since the value is to be shown in financial accounts, since we have a GST application, we can take input tax in there. So we are automatically booking the transaction in our accounts. So then automatically we should give some effect in form fees. So that's why.
Maybe we'll look into it, we can discuss offline. So like I was saying, Schedule 3, where it says activities which will not be treated as supply, so between employer and employee in the course of employment. So long as we are able to prove that this is included in the CTC, we can take an argument to say whatever is the facility, canteen, transport or any other facility which is given to the employee free of cost will get covered under Schedule 3. But the moment recovery is made, then the nature of the transaction itself changes. So here also I wanted to highlight another. Of course, this circular was issued in 2022, Circular 172, where they clarified that if it is a perquisite under Income Tax Act, then you can take the benefit under Schedule 3. So if it is included in your CTC and if it is disclosed as a perquisite, then you can take an argument that whatever is the facility or whatever is made available to the employee by the employer is in the course of employment, and as a result of Schedule 3, it will not be deemed as a supply. Why I have extracted this circular is to discuss this particular AAR. So in this particular, this is Tamil Nadu Appellate Authority for Advance Ruling. So the Authority for Advance Ruling also gave an adverse order which was challenged before the Appellate Authority. So here the facts of the case is that the applicant company allows a facility where the employees who belong to a particular grade, they are eligible for this car leasing option. So the company will enter into a contract with the leasing, that is car lease company. The vehicle as such will be in the name of the company only, and the lease premium will be paid by the company, but it would be recovered from the employee. When we say recovered, as the facts of this case stands, what was put forth or what was explained by the applicant is that, say for example, there are two employees in the same cadre, both of them are entitled to this option. One employee avails this option, the other employee does not avail the option. If you see the calculation, the CTC to the company is same for both. So if it is 40 lakhs and 10 lakhs is towards this car lease, what the other person who has not opted, he will get 40 lakhs in cash. The person who has opted will get 30 lakhs in cash. This 10 lakh will be recovered as lease premium. So here the company tried to argue saying, and for income tax purpose, this was treated as perquisite only. So company referred to that circular and they said, this is a perquisite which is given by the employer to the employee. So this is very much covered under Schedule 3, and this is during the course of employment. Fact that the vehicle is registered in the name of the company, or the fact that this is made available only to specific categories or cadres of employees is not relevant. So here the authority held that they disregarded this circular. They have interestingly held that perquisite means something in monetary form only. Because this is non-monetary, this is not, or the benefit under Circular 172 is not applicable, as a result of which GST is payable. We cannot take shelter under Schedule 3. Like I said, at the advance ruling, is not binding on everyone. It is binding only on that particular applicant in that particular state. For the very same company, this will not hold good if they operate from Karnataka or Maharashtra or anywhere. However, I just wanted to highlight this where they have said only the actual, this is the wording they have used, only the actual value in monetary terms extended to the employee concerned in the course of or in relation to employment qualifies as a perquisite, and it squarely falls within the ambit of entry number 1 of Schedule 3. In your case, they are recovering the amount. It is not a perquisite. So you cannot take shelter under Schedule 3. It is deemed as a supply as per Schedule 1 and tax is liable to be paid. This was the ruling given in this case. Of course, whether it is right or wrong, it depends on each facts and circumstances. But like I told you, so long as we have something contractual to establish that the benefit or perquisite or whatever is given either in monetary or non-monetary form is during or in the course of employment, and it flows from the employer to the employee for the services rendered by the employee, we can always take an argument to say it will not qualify as a supply under Schedule 3. But the moment they recover something, even if it is minimal, then the entire scenario changes, as a result of which tax would be payable under on the open market value. So with this we come to the end of the session. If there are some doubts, we can take it up. I will be sharing the PPT. If there are any other doubts, we can discuss offline. Thank you.